there are a lot of non-fundamental factors that are going to interfere with markets and cause volatility.
The market is finite, and we've already seen some volatile days.
It's a little white knuckle moment that we're going through in tech.
Liquidity is the most important factor for these markets to keep on rallying.
I think this year we have the chance that we beat earnings nicely.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, tech stocks bounce. Equities looking for a firmer footing going into the SpaceX IPO. As higher-than-expected capex at Oracle is spooking some investors, OpenAI is reportedly considering drastic price cuts in a renewed push to take on Anthropic.
There are two sides of a similar story. Both of these indicate that the pace of spending is increasing disproportionately, and the story with OpenAI shows who's going to pay for this, because ultimately customers are pushing back. You saw this with Uber cutting back some of their token usage as a result of just really high costs. Is this the death knell, right? I mean, how can a place like OpenAI end up financing the incredible capex expenditures that the likes of Oracle just keep accelerating without the revenues from higher fees?
Just frame this moment. It's an important moment. We're questioning both the price of the product and the cost of the build-out simultaneously. That's a tension that we've got to resolve, and pretty quickly. And think about the pushback we've seen so far in just the last week. Meta and the FT considering raising equity capital. Stock market pushes back. Supermicro yesterday looking to raise $7 billion in equity. Stock gets absolutely hammered. Oracle spending higher than expected. Pushback again this morning. That pushback is building.
You've been asking, and we've all been discussing, when would the capital markets start to say, hold on one second, are we seeing the beginning of that? And this is really what people have to start asking ahead of all of these huge IPOs, OpenAI among them, as they cut prices and potentially margins. The key issue is that the spending is accelerating, and Oracle just highlights that. $20 billion more in capex that they're expected to do for this foreseeable future. Goldman Sachs coming out with a report saying that capex spending probably is going to equal something like $1.4 trillion next year versus less than $1 trillion. All of this coming with markets just reaching this indigestion point, and you just start to wonder how much this will curb some of that AI enthusiasm.
Because it's so big so quickly, what the market needs to digest. But when it comes to OpenAI, it's like they're chasing those enterprise customers that Anthropic already has. So they really almost have no choice if they want to keep up with where Anthropic is. You know what Anthropic is saying? I love this part because I focus on policy. It's saying the U.S. government and Washington need to start regulating better, and we might have to have some more policies in place and guardrails in place. Lisa's shaking her hands. I know, because it's the CEOs talking about what Washington should be doing, and it probably won't.
No, it's because it's saying everybody else, you guys can freeze, we're ahead, let's just stop the clock. At a certain point, if it's self-serving.
I'm always skeptical of companies asking for the regulator to step in, right?
For the others.
Come on. Let's talk about crude as well. Brent and WTI. This is the scene right now in the commodity market. Brent at 92, down 1% on the session. WTI still trading in the 80s, even though the US and Iran have been traded strikes.
They have these strikes. The president says he's going to continue if Iran refuses to come to this peace deal. Remember, I spoke to the president. He said 2 or 3 days there'd be a peace deal. Well, now we're back to hostilities, kinetic warfare right now. But potentially this could push Iran to the negotiating table. The president also put out a truth yesterday saying more barrels are getting to the market. That's an interesting story, and it'll be good to put some numbers on that.
Let's talk about the morning ahead of us. Later this morning, 8:15 Eastern Time, an ECB interest rate decision. Let me remind you of some dates. July 2008, April 2011, July 2011. Can you add June 2026 to that list of policy mistakes? The ECB hiked into GFC. The ECB hiked into the Eurozone debt crisis not once, but twice.
And ultimately, the market is pricing in something similar this time. The idea not just of a rate hike today by the European Central Bank, but a rate hiking cycle. We now have 2 full rate hikes priced in both today and then again in September, even though the growth outlook is souring, even though you don't see the same momentum in the European region that you do in the United States. Does this require a rethink of the single mandate central bank? Or is this just sort of the destination and the path of travel? How does the currency respond? Do they reward rate hikes, or do they reward the potential growth that comes from perhaps being less restrictive?
I think a lot of people in FX would worry that you'd punish the decision. not rewarded. Equity futures this morning positive by 0.75% on the S&P 500. Coming up this hour, we'll catch up with Julian, Emanuel of Evercore as Wall Street awaits the mega SpaceX IPO. Yahya of the Carnegie Endowment of International Peace as the US carries out another round of strikes on Iran. And Zino of CFRA as Oracle falls on plans for a massive capex push. We begin this hour with stocks recovering as SpaceX is putting together its historic public offering. Julian Emanuel of Evercore suggesting the bull market has room to run, writing the SpaceX IPO is not an endpoint like the AOL Time Warner merger in Y2K. It's a data point on the way to higher prices. Julian joins us now for more. Julian, good morning.
Good morning.
It's hard for people to internalise, given the move we've seen off the low, that maybe the FOMO and the melt-up is ahead of us and not behind us. Do you think it's ahead of us?
It has begun, but actually, if you look at the last 5 days and the sort of buttoning up of sentiment and the caution that we've seen, again, in these last 5 days, I would say that the true FOMO, the wild-eyed, buy at any cost, whatever it is, I'll take it, is still potentially ahead of us. But if you think about it, though, the market is really digesting all of this pretty well. Think about the headlines that we're dealing with this morning. We had strikes overnight. We've got the premier AI company talking about price wars. We've got the marquee software company that is dealing with capex issues. All of that negative, and yet the stock market is incredibly resilient in front of really a landmark moment.
Well, let's sit on the third point, the signs of fragility, the pushback to Oracle, the pushback to Supermicro, the pushback to Meta. That's adding up, is it not?
Look, and I think we've said this in past, it's become a market where it's not actually even billions anymore, it's trillions that we're talking about. And yeah, 85 billion here, 75 billion there. It really does add up, but it also speaks to the incredible liquidity conditions that we're seeing. And in fact, and part of the reason that despite the geopolitical disturbances of the last several months is that the economy came into this incredibly resilient. And what did we find out last Friday? The labor market is a lot stronger than we could have ever imagined it would be.
Do bond and stock investors want to keep paying for something that customers don't even want to pay for? I mean, ultimately, isn't that the message coming from OpenAI? That people don't want to pay the prices that are being charged, even though that's what's being financed essentially in bond and stock markets.
So there's certainly a pushback to there's a pushback to every aspect of inflation in our environment right now, whether it's, token prices or cattle prices or gasoline prices. But I think when we look at how AI has progressed over these last several years, the Jevons paradox seems to continue to be operative. If token prices come down, which there's every indication that they will, you're probably going to get increased usage.
Is it telling to you that we've seen this bout of volatility really come along with yields being the highest relative to the earnings yield in the S&P 500, a relative metric going back to 2003? I mean, essentially, bonds are offering a more attractive proposition as yields go up and as some of the valuations go up, and you see this relationship kind of become a little bit more even.
Well, and actually, it's a rational response, right? If you look at classical finance theory, the point is long duration assets, high value assets, like technology stocks, should be more sensitive to higher yields. And that's what we're seeing. But ultimately, when you look at past episodes of structural bull markets like the one that we're in, compared to, let's say, the internet in the late 1990s, or frankly, Japan in the late 1980s, you had a tolerance for higher yields as long as the economy was continuing to move forward, and confidence, which has been lacking on the consumer side, even though there's been spend, remains stalwart.
Can we talk about the consumer side for a second? The Washington Post has a story out this morning that oil executives are going to the White House and saying they're concerned that gas prices are going to rise. What happens when we hit $5 a gallon?
That for us is white knuckle time. We have made it clear that the work that we did around prior oil price spikes when the war started in March really showed that the window given the strength that we came into at the war in terms of the economy and the strength that's remained, you've got about sort of 4 months and literally $4.50 or triple-digit WTI. The strains will start to show in the economy and likely the stock market, which again is why I think there's such a sense of urgency coming from Washington to figure out how to solve this.
No sense of urgency in the oil market right now, though, right? It's pretty impressive, isn't it? 92 on Brent, 89 on WTI.
It is quite impressive, and you know, I think perhaps speaks to the president's statement yesterday that we're able to get barrels out of the strait one way or the another.
Crude down this morning, equities higher, up by 0.75%. Julian and Emanuel of Evercore will be sticking with us this morning. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Thank you. Oracle shares trading lower in the pre-market as its data center costs overshadow its AI growth. The company reporting capital expenses that came in higher than Wall Street estimates. Shares are up nearly 30% over the past 2 months. The European Central Bank set to raise interest rates for the first time since 2023 due to rising inflation caused by the Iran war. Economists are expecting the central bank to hike by 1/4 point. Surveillance will have complete coverage of the ECB rate decision at 8:15 Eastern. Anthropic's CEO showing support for government regulation of AI. Dario Amodei writing in an essay, the government should have the power to block AI developers from deploying new models if they present certain risks. Amodei saying there should be mandatory testing by third parties. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Quick programming note for you. Happening right now, the Bloomberg editor-in-chief, John Micklethwaite, sitting down with the Anduril CEO, Brian Schimm, for the Founders Forum about the role AI plays in defense and military technology. Any headlines we get from that, we'll bring them to you. Up next on the program, we'll be talking about the latest in the Middle East. Escalating pressure on Iran.
We're going to be attacking them very hard. We'll see what happens with the deal. We were really close to a deal, but they keep tapping us along. They keep playing us for suckers.
Joining us in just a moment, Yahya of the Carnegie Endowment for International Peace, plus more with Julian and Emanuel of Evercore. Live from New York City with the mug in prime position. From New York City.
And my outfit.
You're watching Bloomberg TV. 8:30 Eastern Time, more data for you. We get some jobless claims a little bit later this morning. Heading into this at 8:15, an ECB rate decision. 30 minutes later, a news conference with Christine Lagarde. I mentioned the hawkish policy mistakes that this ECB, this institution, has made previously in 2008 and 2011. Go back to the 2008 decision in early July. That hike came on the same day that oil peaked, because believe it or not, back then they were also concerned and freaking out about crude. It was also the same month that inflation peaked. The ECB made a series of mistakes here. Never mind that was going into the GFC, and that they repeated the act in 2011, not once but twice. These are the questions being asked in Europe right now about this institution going into this hike that's widely expected.
And it's not just going to likely be a hike, it'll be a rate hiking cycle. People are talking about the potential that oil prices are peaking, even though maybe we haven't gotten a resolution yet, and that inflation will likely come down in the region. Again, how much history can rhyme.
Ollie Crook on the ground in Frankfurt. We'll catch up with Ollie a little bit later this morning. Equity futures on the S&P elevated, bouncing back from 2 days of losses. A two-day losing streak, the longest of the month so far. Up by 0.75% on the Nasdaq. We're up by 1.2. In the bond market, we're behaving just a bit. 2's around 412. 10's around 450 still. That runaway move at the back end of the curve has settled down as well.
Yeah, even yesterday we saw a 10-year note auction that went pretty well. It actually performed in the after hours. Today we get more. And do we get the same kind of reception is going to be key, especially for a 20-year auction that typically is a little bit hairy. Ultimately, is this a way of people saying suddenly bonds are looking a little bit better as the proposition for AI is looking maybe a little bit more skeptical under the eyes of all of this CapEx spend?
Might be in the hands of the commodity market, at least for now. Crude, Brent, WTI pulling back just a bit. We're down 1%, even with this taking place in the Middle East. Under surveillance this morning, escalating pressure on Iran.
We're going to be attacking them very hard. We hit them hard yesterday, and we're going to hit them again hard today. We'll see what happens with the deal. We were really close to a deal, but they keep tapping us along. They keep playing us for suckers. All they have to do is they have to start signing a paper. It's fully negotiated.
So here's the latest this morning. The president vowing more attacks on Iran if it does not agree to an interim peace deal. The president telling Fox News Iranian officials called him directly last night, asking him to stop the bombing. Bloomberg's Tyler Kendall has the latest. Good morning, Tyler.
Hey, John, good morning. Well, the White House is framing this latest escalation as a way to force Iranian concessions at the negotiating table after President Trump accused Iran of dragging its feet to make a deal. Now, we should say that Iranian state media did deny that Iranian leadership held a direct call with President Trump yesterday after U.S. forces launched strikes against dozens of military targets. We saw Iran retaliate too, launching strikes against multiple U.S. bases across Kuwait, Bahrain, and Jordan in what is now the worst flare-up in fighting since the ceasefire was announced back in April. Iran's foreign ministry is saying that this latest wave of strikes means that the ceasefire is, quote, effectively meaningless. But the message from the U.S. is that President Trump is still committed and thinks that a diplomatic deal can get done. The issue is we know that there are just still so many sticking points that has been fueling this mounting frustration from the White House, mainly including the Strait of Hormuz. As you mentioned earlier on the program, President Trump yesterday said that so far the U.S. has helped to guide 200 ships carrying 100 million barrels of oil, he says, through the strait in recent weeks. As CENTCOM New this morning is denying Iranian state media reporting that the IRGC is trying to tighten its grip over the waterway and has stopped all commercial traffic in the wake of the U.S. strikes. This is definitely, John, raising the alarm, of course, across the region as we start to see some more regional partners enter the conversation. Iran has confirmed that a Qatari delegation landed there yesterday in a bid to help the peace process get back on track.
Tyler Kendall in Washington. More from Tyler in the next hour. Tyler, thank you. Let's build on this conversation. Yahya of the Carnegie Endowment for International Peace writing the following: neither threats nor an escalating military confrontation will sway Iran at this point. The regime has adjusted and is doubling down even further. Maha joins us now for more. Maha, welcome to the programme. We're losing trust by the day. How can we negotiate and find a deal with a lack of trust?
Very difficult. Good morning first. Thank you for having me. But it's very difficult to find a diplomatic outcome that is satisfying to everyone with the ongoing military confrontation. I think the ongoing military confrontation, the escalation in military targeting is going to make a diplomatic outcome less likely rather than more likely. The lack of trust between the two parties was very much there even prior to the US-Israeli attacks against Iran earlier this year. And now they've deepened much further. Iran views the U.S. as an unreliable partner and one that has pulled out of a previous agreement, the JCPOA, that they cannot trust what the United States is saying. And the United States seems to be unwilling to negotiate or to acquiesce to some of Iran's if you want, non-negotiable from its end demands. So it makes it very difficult. Basically, the bottom line of what the U.S. is offering is still not meeting, or the best of what the U.S. is offering is still not meeting the bare minimum of what Iran wants. And that makes the gap only grow wider in many cases.
Maha, Iran's economy is, though, facing a severe crisis. At one point, will that hit the top layer of the regime and the individuals that are in charge with making decisions?
It's not clear, to be honest. It's very clear that people have adjusted. The regime has found ways. I mean, they were already preparing for this since the last round, which was in I think it was April 2025, when Israel and Iran had the 12-day war. So Iran was already preparing for the eventuality of a conflict, a direct conflict that would involve the United States. It's not clear at what moment this will hit and whether it will begin impacting them. At this point, with the direct attacks by the US and Israel on Iranian infrastructure, we heard this morning that water facilities have been targeted with precision missiles, which actually could constitute also a war crime. The Iranian people are rallying around their country. I wouldn't say their regime, but their country. They see it as an external attack, and therefore the potential of people taking to the streets, I mean, that's the way it would start hitting. If people start protesting, taking to the streets, etc., is not going to happen.
Maha, do you think this goes through the midterms? Does the regime hold on until through November?
They most likely can hold on till November, whereas President Trump wants this over sooner rather than later. Everything we've been hearing is they were on a cusp, apparently, of a very viable deal prior to the launch of this war. I'm speaking the first round, not this current round. With the assassination of Khamenei, with the assassination of Laranjani and other key members, the regime has shifted. It's reshuffled the decision-making processes. All indications are that Mujtaba Khamenei is holding the levers of power, and they've become a lot more hawkish than the previous regime, if you like. So they can hold on till November. I think they're counting on their ability to hold on till November and making it very difficult for President Trump, but also for ordinary Americans as inflation mounts, as the price of the barrel of oil increases, etc.
November. Maha, thank you. No one's thinking about November here right now. Not in this oil market. Maha Yahya there of the Carnegie Endowment for International Peace. November. Check this out from the Washington Post. Annmarie was talking about it moments ago. Oil and gas executives have warned the White House that gasoline prices could surge in the coming months as fuel inventories fall to critical lows. Julian Emanuel of Evercore is still with us. Julian, that's the tension right now. Oil market's telling you one thing, not much is happening because we're drawing down inventories so quickly and the executives are still on edge. And if you're in the equity market, you've heard it a million times over the last 3 months, you've started ignoring it. When do you have to start paying attention again?
I think really, again, we have sort of targeted the 4th of July as kind of a seminal date in things that are happening. If we are taking the same approach that we're talking about right now, in an unmoving, hardening regime in Iran, and Washington, who really doesn't see how the end game evolves, that's likely going to further send the price of oil higher. And in our mind, that's the biggest threat, frankly, to the entirety of this bull market. It isn't the capital raising. It isn't the questions around CapEx. It's whether the economy can weather a persistent oil price shock. So far, it has, but...
There are two ways to look at this. On one hand, that more barrels are getting through the Strait of Hormuz than people realize, and that actually there is a leakage here that is easing some of the supply constraints. The second is that no one wants to trade oil because you're just going to get blown out. It is a very difficult move. Which is it?
It's both. It's absolutely...
Not happened, Bramo, this morning.
Well, no.
No,
think about it. When the president first said that there were going to be further attacks, the price of oil went from down $3 to down $2.50. And I mean, it was like there was no pulse whatsoever.
There is some energy getting through. We've seen some of the headlines coming through. In fact, the president addressed that just yesterday.
The president spoke about it, but then you look at what ADNOC is getting through. Kuwait is starting to send some more barrels to China. I saw some work being done in Iraq as well, trying to get oil through. But it's not where we were pre-crisis. And the issue, of course, is going to be this race against time where inventories are, because they are very low right now.
Julian, it's good to see you. It's great to catch up. This story in the Middle East right now is ratings death. Like, if you want ratings right now, it's just surround yourself with rockets and sit down at the NASDAQ.
New York Knicks.
Right?
New York
and the Knicks.
That's the rating.
And then put on a Knicks jersey, right?
What do you say about Iran? Headline on, headline off. Let's just talk about the Knicks.
It's a political story. The president went.
It's a lucky charm around the studio. Futures bounced this morning following 2 days of losses, up by 0.75% on the S&P, on the Nasdaq up by 1%, on the Russell up by 1.3%. Plenty of reasons out there right now for this stock market to still be down, but here's your bounce going into that mega IPO tomorrow. In the bond market, we look like this: 2s, 10s and 30s. The focus on the ECB this week, on the Fed next week. It is crazy to think that this ECB, with the economy they have in the Eurozone right now, is hiking interest rates because of an energy shock and inflation, when we've seen that act not once but twice in 2008 and 2011, and it didn't end well at all.
And right now I'm looking at the economic projections for the Euro region, and we're looking at 1.2% growth in GDP so far for this year, 1.5% next year, 1.6% the following year, with CPI expected to come down to 2% by 2028, and they are going to be hiking into that. And this is the reason why people are saying, wait a second, hold on. This is going to be a policy error. And yet, if you are a single mandate central bank, how do they get ahead of inflation that is creeping higher without taking a move? And that is part of the issue of being a single mandate central bank.
That decision at 8:15 Eastern Time. 30 minutes later, news conference with Christine Lagarde, the ECB president. Let's finish on crude. Brent and WTI. On Monday, session high, 98. Since Monday, things have got worse, not better. And yet Brent crude is at 92. And WTI is still in the 80s, and we're down 1% on the session.
It's kind of crazy to look at this board and see WTI below $90 a barrel. As you see in the Washington Post, oil executives are going to the White House and saying we are concerned. There is reason to be concerned given where we are in inventory levels. I think the market is just saying maybe we can live with this. Even if the strait is closed longer, the president says more crude's getting out. And we are also seeing Kuwait, ADNOC, Iraq, they're able to get more barrels out. The issue is, of course, peak driving season. This can get tenuous if these strikes continue.
No one believes the headlines. I mean, say whatever you want. This is happening. That's happening. People are like, la, la, la. Tell me when it's over, or tell me when it accelerates. Then I can trade it. Otherwise, I'm going to get blown out if I try to take any side in this.
I believe in price, particularly in commodity markets, and particularly the physical market, because you have to clear demand and supply at spot. And clearly, we're getting the supply. Now, we're getting it from certain places like inventories, and it's coming down really, really quickly. So you can stabilize price for now. And this is what the energy executives are worried about. Once you get to critical levels, you get this non-linear move in the other direction. It's really dramatic and fast. It's like the pandemic in reverse. That's the story here. So don't get too comfortable with where things are at right now, because things can change really quickly.
I would agree with you. This is a point that Jeff Curry has been making. Halima Croft put out a great note yesterday talking about how the price corrective mechanism just isn't working because people aren't worried enough, and you are getting about 2 weeks, 3 weeks away from tank bottoms, and at that point you will have that non-linear move. But the music's still going. So keep on dancing, and the Knicks just, ended up winning.
Keep winning, right?
Yeah.
In 5?
Yeah, I think so.
Right, okay, good.
I hope so.
Then we're moving on.
over there.
We got to wrap
Then we
it
sort of
up.
focus on the World Cup. Have you done your bracket?
You've not done a bracket yet.
I've done my World Cup
really?
bracket. Yeah, I might make some tweaks, but I've done it.
AC Milan at the top. I know they're not even in.
Not in the World Cup.
I know.
Not
I know.
a country.
Not
a country, Bramo.
But you know what she meant. And it's a sore subject
Kinda.
that Italy is not in this World Cup. And
Whatever.
it's sad. It's like pathetic.
BRKT on the Bloomberg terminal, if you'd like to do your bracket, Bramo.
Who do you have winning?
I have a Brazilian at home, so I have Brazil winning.
Right.
Whether I believe Brazil wins or not.
Happy wife, happy life.
Precisely. So they need to win.
This is a real passionate bracket.
3 hours away from the cash open. Some morning movers. Yahya has more. Hey, Yahya.
Hi, John. Despite another quarter of blistering AI growth, we are seeing Oracle shares falling 7.3% in the pre-market after the company said it will spend more than projected to build out AI data centers. And that came as Oracle left its sales outlook largely unchanged, leaving investors wondering where the payoff is from all that additional spending. Moving on to the chip stocks, they are staging a comeback today with NVIDIA up 1.2%. Some of that having to do with Oracle's spending plans helping to reinforce the demand story. But you also had a note out from Morgan Stanley on the memory names, so Micron and SanDisk, saying that a correction was necessary after a massive run and that they do not see the memory cycle over for now. And we end on JD.com and Alibaba, the Chinese e-commerce giants. Both are weaker in the pre-market after CCTV reported that Chinese regulators scolded the companies publicly for what they're calling misleading promotions ahead of a big holiday shopping day next week. This is just the latest move by Chinese regulators to crack down on race to the bottom discounting in the sector. John.
Yahya, thank you. Thanks for the update. On our radar this morning, Oracle falling in the pre-market. The company reporting larger than expected capex driven by increased spending on data centers. Those costs overshadowing Oracle's AI growth. That stock is down by 7%. Elsewhere, Democratic Senator Elizabeth Warren asking the SEC to delay the SpaceX IPO. Warren citing concerns over the company's historic $1.8 trillion valuation and Elon Musk's, quote, uniquely unchecked power in the company. And finally, OpenAI considering drastic price cuts in an effort to win customers from rival Anthropic. The Wall Street Journal reporting this morning the company could reduce the cost of so-called tokens in anticipation of a similar move from Anthropic.
This is getting a lot of attention because it's raising the ultimate question of, is AI getting to be too expensive, at least the most extreme and cutting edge models for rank and file companies? In other words, is the target audience maybe not as big, the addressable market not as big as some people have been projecting as they increase their capex dramatically? Citadel put out a great note talking about this. Are we going to see a bifurcation in the AI sphere where suddenly the frontier AI models are going to go to a couple of well-heeled customers, and the rest of the universe is going to look for commoditized, cheaper versions to execute basic things like picking your bracket for you? So ultimately, we're going to see how this shakes out, but it's a warning shot at a time where some people are getting worried about costs.
That's good. I should maybe use Claude to pick my bracket. Also in this Wall Street Journal story, they said the move would be in anticipation of similar cuts the company expects at Anthropic. So at the same time these companies are going to market, they're going to be having to cut prices.
We're cutting prices, and at the same time, we are pushing back against the price of the build-out. Something doesn't work there, Lisa. Something doesn't work.
Which is why Oracle shares are down more than 10% this morning, or now they're down 7%. They were down more than 10% earlier this morning. At the same time, overall, the Nasdaq's rallying. Overall, people are flooding back to this market. There's just a break in the narrative. Is this an OpenAI story, or is this a broader story for AI? And that, I think, is really the key question.
Let's spend some time on that. Oracle shares this morning sliding as high spending is spooking investors. As I say, that stock is down by more than 7% this morning. Angela Zino of CFRA maintaining a hold rating on the stock and a 12-month price target of 194, writing, we expect capex to remain aggressive in the foreseeable future, which is more burdensome to Oracle investors compared to better capitalized hyperscalers. Angela joins us now for more. Angelo, good morning and good to see you. Is this pushback going to change the strategy of the company?
Yeah, John, thanks for having me. You know, I think when you look at the Oracle strategy here and you kind of look at the metrics overall, I mean, there were a lot of good things that happened, right? I mean, most importantly, I'd say that RPO number did increase. It does appear like that increase in RPO is a bit of a diversification also away from OpenAI. That's a good thing to see. But also importantly, they didn't necessarily boost their forward expectations in terms of revenue, right? Which to me might also tell me that maybe some of those OpenAI commitments might be being pushed out further down the line. But that being said, I mean, you look at what's happening right now, you look at the GPU utilization rates within Oracle's data centers, they continue to be high 90s. Those metrics are extremely, they're important in the sense that, hey, listen, everybody's buying their capacity, so they need to continue to spend aggressively. So I think that it justifies the higher spending. But that being said, I mean, and you look at the revenue run rate right now, you're looking 20% plus, this quarter, expectations in the following year north of 30%, and we think north of 40% the following year thereafter. But, maybe to the point you guys had just referenced, one, is the demand going to be there as we kind of look ahead? But right now, everything is telling you that it is going to be there.
Well, Angelo, to that point, there are exponential increases in capex. At the same time that customers are starting to push back on the margins. And maybe these are anecdotal stories, but do you think that it's a warning shot that OpenAI is thinking of cutting prices at a time when capex bills are just going to the moon?
It's a warning sign in the sense that, hey, listen, I mean, if demand was as strong as it was, right? I mean, you wouldn't necessarily need to cut prices. But in the same respect, I mean, you kind of think about the longevity of AI and how this kind of works out over time. I mean, prices do need to come down. Adoption rates need to continue to increase. And you kind of get this, this circular pattern in many respects where over time, the greater adoption rates will continue to fill those data centers, and as a result, you need to continue to aggressively spend. And as you get that volume continuing to tick up, that hopefully does justify the investments. So a lot of moving parts, But as long, again, I think right now the place you want to be is on the chip side of things, because it doesn't seem like there's any end as far as some of these, some of the spending goes. And when you kind of look at some of these IPOs that are going to come out here over the next couple of months, I mean, clearly all of those proceeds are going to be reinvested right into that AI infrastructure build, right? So again, the place to be continues to be semis.
Angelo, it's not whether AI is real and whether it is truly transformative. It's what price investors are willing to pay for it and how much money they're willing to fork over, and frankly, how much cash is still, quote, on the sidelines, as people have been saying for the past 30 years. And they keep saying, do you think we're reaching the limits in terms of just valuations, given the fact that people believe in the story, yes, but they're getting a little skeptical of how much they're going to be on the hook for ultimately what could be something not only of a commodity, but just utility?
Yeah, I mean, I think you've got a point there. I mean, when we think about, you kind of look at just the token generation that we've seen here over the last couple of months, right? I mean, clearly, to your point, AI is real. Demand is exploding. Enterprise companies are, blowing out their budgets, in a short period of time, and they continue to increase their AI budgets. So, from that trajectory, everything continues to be good, and as a result, you continue to justify that higher spend as we kind of look ahead. To the extent of how this all plays out, I think in many respects, I mean, if you're a hyperscaler and you're generating the tens of billions of dollars that you are in cash flow, you're going to continue to blow out, your cash flow to continue to invest in AI in many respects, because you've got all these new emerging entrants out there that is really kind of taking business that in some respects should be yours, whether they're neoclouds, whether they're new IPOs that are coming out. That's business that's potentially yours. So big tech in many respects does have a big problem in the sense that they need to continue to aggressively spend no matter the circumstance, as well as the fact that you've got new competitive pressures that are entering the market. So you've got a number of kind of moving parts there as well.
Angelo, how far behind is OpenAI from Anthropic when it comes to the enterprise customer base?
I mean, it's tough, right? It's tough to really say. I mean, we'll see, I guess, in the coming weeks, hopefully when we see some of these S1 filings out there. I would say, listen, when you look at OpenAI, clearly they've been full throttle in terms of on the enterprise side of things. So they're clearly a step ahead. Based on anyone you'll kind of talk to, I mean, clearly most enterprises will continue to favor some of the applications that OpenAI has rolled out, and not to mention what they've done across the stack, going from those LLMs to the enterprise applications that they've rolled out, I think is significantly superior to what we've seen from OpenAI thus far. OpenAI realizes they do need to catch up in many respects. Again, to what magnitude they can cut that down, we'll see. But clearly the focus on OpenAI up until a couple of months ago has been equally or maybe a little bit more tilted towards the consumer side of things. We're now realizing, as far as monetization of AI, maybe they should have tilted a little bit more to the extent that Anthropic has.
So, Angelo, what do you make of their push, their openness, if you will, to have a conversation about giving up equity to the US government? Is that out of the goodness of their heart to share the profit, or is this about sharing the burden?
It's probably sharing the burden a little bit, right? I also think, potentially there is an opportunity here for OpenAI to get a little bit more entrenched and connected with the U.S. government. I mean, we'll see what the opportunities are going to be out there as far as sovereign AI initiatives goes, right? But as far as OpenAI is concerned, I think kind of developing, a stronger connection with the U.S. government is probably a good thing for them on a number of fronts, whether it be kind of sharing some of the obligations out there, or whether it be potentially finding new revenue opportunities that maybe the U.S. government can help them with.
Angelo, appreciate it. Thank you, sir. Angelo Zino there of CFRA. Might be good for OpenAI. Is it good for the US government?
Is it good for us, right? I mean, ultimately, if they're going to be sharing the burden at a certain point, great, it would be good for them. Is that really what we want to see?
Yeah, NASDAQ futures this morning up by more than 1%. No one really wants to say it, do they? They're kind of hesitant. They know what they think, but they don't want to say it right now.
Nobody wants to come out and say that OpenAI is overvalued and perhaps is the story that is a bit of the Trojan horse. And people have been saying that anecdotally for about a year now. suddenly are we seeing the beginnings of the cracking in that
Speak
story?
your mind. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The U.S. carrying out a second straight day of strikes on Iran. The attack coming after President Donald Trump accused the country of dragging out peace talks. Trump telling Fox News the U.S. will hit Iran again today if it doesn't sign a deal. Oil and gas executives telling the Trump administration gas prices could spike in the coming months. The Washington Post reporting industry officials are cautioning the White House inventories could be gone within weeks as summer travel season is in full swing. In sports, the Knicks are one win away from their first NBA championship in more than 50 years. New York making an historic comeback to beat the San Antonio Spurs 107-106 with 1.2 seconds left in the game. Game 5 is on Saturday in Texas. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate it. I know we spent tons of time talking about the price of entry, the get-in price to go to some of these games. What about the value of sports content? In this world of AI that we're all talking about, the value of this kind of content that's only going up after things like this.
People want to be part of that excitement.
Right?
Also, you see all the celebrity roles of all the people who are there, and you see the sort of
Mike Bloomberg got to sit next to Timothy.
Timothy? Is that?
I noticed the same thing. And Kylie.
And Kylie. Pretty cool.
The point being that this kind of raw joy and excitement and uncertainty and humanity is going to be in premium.
How many mornings have I sat here and said, bad product?
100%. I was going to say, like,
Bad
all of a sudden.
product.
Yeah. Really? You still think so?
This is the dream final, right? To turn around what otherwise has been. Bad product.
Is that your line now?
I think they want to extend it. Let's just put it that way.
Stop.
I think they'd like it to go beyond Game 5.
No. You think that this is rigged?
Not what I'm suggesting.
But you think that who's they?
The NBA. I'm
Sure.
suggesting they would like
Okay.
it to go
Sure,
further.
but hopefully-
By what means? That is up to you. You used the word
Oh
rigged.
my
I didn't use the word
God.
rigged.
All right. Let's hope they win.
That's not what I said.
That's what you implied.
It's not what I said.
Good juju only. Knicks in 5.
Up next on the programme, central banks in a balancing act.
We're seeing distinct upside pressures on inflation. And central banks around the world are debating about what to do about it.
Ian Steely of JPMorgan joins us next. Got a message from a Bloomberg subscriber. The absolute worst nightmare for brides getting married on Saturday in the New York area with the Knicks game taking place.
Maybe it's on purpose and they will wear exactly what Annmarie is wearing this
Maybe the brides will be watching a game too.
You think so? Yeah.
They could do orange and blue flowers. And
Annmarie.
also, as Trump would
here we
say,
go.
that's life.
Wedding planners everywhere rushing to buy orange and blue flowers.
Yeah, lean into the theme.
Yeah, it's true. Just change the date.
Swift at MSG getting married there. You seen that rumour?
Yeah.
That's crazy. Don't think much of that.
A private wedding.
All that money, and that's pretty tacky, right?
What's by MSG?
Above Penn Station.
Above
is how
a
you
train
need to think
station.
about
There you
it.
go.
And then you're
A
kind
wedding
of like,
above a train
it's fine for the Knicks to win at MSG, but to get married above a and New Jersey Transit, no.
The stadium above a train station doesn't sit well with me either. But anyway, futures on the S&P, positive by 0.75%. We're bouncing back this morning by 1.2%. In the bond market, focused on the ECB this morning. An ECB rate decision just around the corner. Under surveillance this morning, central banks in a balancing act.
We're seeing distinct upside pressures on inflation. And central banks around the world are debating about what to do about it. Central banks are likely to be more aggressive, and you're not going to hear that transitory word uttered by a single central bank.
So here's the latest this morning. Global central banks walking a tightrope ahead of a pivotal rate decision, starting with the ECB this morning. Expected a hike for the first time since 23. Ian Steely of JPMorgan Asset Management writing, in line with market pricing, we expect a 25 basis point hike with further increases in September and next March already priced. Ian joins us now for more. Ian, good morning. Good to see you.
Morning.
Let's talk about these hikes. What are you expecting from Lagarde later this morning?
I think in a perfect situation, she's going to want to come out of this meeting with effectively the market where it is today. So they're going to hike rates, we know that. I think what the market's going to be focusing on very much so is the forecast, because we're going to expect growth to be coming down, we expect inflation to be coming up. How much do they, how much do they move? And then, of course, the press conference. And does she try to steer away from effectively forward guidance? Does she say, look, we're data dependent, we're going to be continuing to watch the data? They don't know what's happening with the Strait in the next few weeks or so. So they're going to sit on their hands, say we're done today. Let's see what happens going forward. I think that's what she wants to come out with.
July 08, April 2011, July 2011. 3 bad decisions from this ECB. Does June 2026 get added to that list? Why is this different?
I think, so the ECB is a different situation to, say, the Fed or the Bank of England, because they've taken rates down to 2%. They've taken rates down to what they perceive to be neutral. You talk to the Fed, you talk to the Bank of England, they will tell you we're still mildly restrictive. You may or may not believe that, but that's what they'll say. The ECB, they're stuck neutral. So they have the ability to just effectively lever the rates up a little bit, because Lagarde said it at the end of March, the public needs to know what the reaction function is and needs to know that they're going to be able to react to it. Inflation's going up. They're a single mandate central bank that effectively fights inflation. I think 25 basis points isn't going to effectively be the end of the Eurozone as a whole. I think they just want to have that credibility in the system.
At this point, they've got the credibility. If you take a look at what the expectation is for inflation, it's expected to come down to 2% in the next 2 years, and then potentially below that for the European region. You're also looking at GDP that's decelerating, not accelerating. They have a very thin margin to work with. Why do you think that ultimately inflation could get embedded coming from a supply shock, given the way that the Euro region is set up?
I think they're going to come out of this, and I'm not sure inflation is going to become embedded. I think ultimately there will be more of an impact on growth later down the line. But what they're wanting to do is, to your point exactly, is to have that credibility, is to have the market continue to believe that they are an inflation-fighting central bank. You just look at what's gone on in Asia over the last few weeks or so. Central banks that were pausing or delaying what was effectively inevitable, they've had to effectively now play catch-up. And I think the ECB do not want to be in that position. So let's go early and hopefully not have to do too much, and then let's see what happens.
Would you rather be in European bonds right now than the U.S.?
Definitely.
Right now, do you think that the U.S. is losing that credibility?
No, I think actually the US has got a different situation going on, where actually you're seeing what looks like a re-acceleration in the labour market. You've got the AI trade over here, you've got the tech trade over here. We don't have that in Europe. I think
we
actually
don't have rate hikes either.
You don't, but you've got, you've got close to 50 basis points price versus Europe has got, 70 basis points price. There's not a huge difference now. There's been a big catch-up in the front end of the US relative to Europe over the last few weeks or so. I just think the US is a much better story. I think actually European front-end rates, I do think there's value to be had there. I don't think they're going to be hiking 3 times over the next year.
The US is a much better story. Does that make the US bond market a much worse story? How bearish are you on treasuries right now?
I think you're looking at the Treasury market where actually you'd argue more around fair value. And I think the starting point is so important. I was just looking this morning. So we're 35 basis points higher in the 10-year yield year to date. If you look at the US Ag, it's effectively flat. That yield cushion is so much different. For all the people that are concerned about fixed income, remembering 2022, it's just the starting point. It's so much different. The yield you've got, the carry you've got, the steepness of curves, the roll down, it all helps. So yes, you can have rates move a little bit higher, but actually you still have returns. And I think we're 35 basis points higher. We're 4.5% or so on the 10-year. I could build you a global portfolio of bonds that yield you 6%. I think that's pretty attractive in this environment.
Quick yes or no, have you got the Fed hiking this year?
I think the Fed will do what they can to be on hold over the course of this year.
OK, Ian, good to see you. Thank you, sir. Ian Steely there of JPMorgan Asset Management. 450 on 10s, around 5% on 30s.
The idea that the U.S. doesn't have to hike rates, even though it has a much better economic projection, and yet is maintaining credibility, is the reason why people's heads, like mine, are tied up in knots.
Yeah. Kevin Walsh next week. Over to you. The new Fed chair in his first Fed meeting. Up next, we'll catch up with Francis Donald of RBC, Ed Mills of Raymond James, Ted Mortonson of Baird, Mike Pyle of BlackRock. The second hour of Bloomberg Surveillance just around the corner.
The safest thing the Federal Reserve can do politically and also economically, I think, is just to do nothing.
You do have this higher resting heart rate for inflation.
Now, most Fed officials, of course, are going to be fine leaving rates as they are.
Core inflation in the U.S. still looks like, it's on a trajectory that eventually should be okay for the Fed.
We need to see the Fed remove the easing bias and ultimately remove the insurance cut from last year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action of scores look like this. Bouncing back from a two-day losing streak on the S&P. We're higher by 0.7%. On the Nasdaq, up by 1 full percentage point and change. In the bond market right now, check it out. Treasuries, 2s, 10s and 30s. Yields lower by 2 basis points on 2s, down 3 on 10s. Still around 450 on a 10-year, with crude still depressed, even with fresh strikes in the Middle East. We're down by 1% on Brent. WTI with an 89 handle. Later this morning, data at 8:30 Eastern Time. Jobless claims. Before we get there, an ECB interest rate decision at 8:15, and 30 minutes later, a news conference with Christine Lagarde.
She has quite the job to do, given the fact that right now the market is baking in 70 basis points of rate hikes by the ECB for the rest of this year. This is a rate hiking cycle that's getting priced in, not just one and done. And it comes as inflation, yes, is elevated in the region, but growth is not. And they don't have the drivers, including the NICs, that the United States has to potentially generate some of the hopes and dreams that we see coming out of the stock market. Is this going to be a mistake? And ultimately, everyone in the U.S., I'm getting messages all morning, huge mistake. Idiotic. People in Europe, no, this is right to anchor inflation. So it's just It's two different universes this morning.
PPI in America later this morning is expected to have a 6 handle. Jobless claims is expected to come at around 220. And we're having these fun and games in America talking about removing an easing bias. Now, I know I've talked about this a million times and sound like a broken record, but it's kind of crazy, isn't it? We're talking about removing an easing bias in America with data like that. And the ECB is talking about hiking not once, and everyone's waiting for the guidance to go twice and go 3 times.
Yeah, this is a reason why it's like 2 different markets that we're talking about on one hand. In Europe, they've got to anchor inflation expectations that, by the way, are fully anchored. If you take a look at the inflation expectation for 2028, it's 2%. It's not 2% in the United States, at least not by market expectations. Over the next 10 years, you're still looking at north of 2%. We just had the first 4 handle on CPI going back to 2023 when the Fed was engaging in a rate hiking cycle. Somehow people think that the Fed can get away with it. Look through this because of productivity, because of potentially the idea that growth is going to slow. Potentially there is fragility in the labor market. There are a lot of postulates that people are putting out there, but not necessarily facts to show how it's going to come into place.
Well, an argument they're going to make, too, or individuals that don't think they should hike is going to make that's just going to hurt the people that actually need interest rates to come down. It's not going to stop the massive AI spend, and maybe the Fed does need to look through this oil shock, because you look at the oil price board, it is pretty insane that we have fresh strikes between Washington and Tehran, and we have WTI under $90 a barrel.
Down just 1% on a session right now. Crazy. Let's bring up a single name, Oracle in the pre-market. Check out the pushback to higher spending from Oracle. That name is down by close to 9%. Yesterday, we were talking about Supermicro. That name finished lower by 28%. One session, 28%, because they're looking to raise equity capital. What did we see from Meta last week? Report from the FT. Looking to raise equity capital, considering that pushback in the stock market. This is my focus right now. It's our focus, the pushback you're seeing in capital markets.
We've been asking when would that happen, and maybe that moment is starting to come to the fore, because it's not like Oracle delivered bad earnings. They actually increased their earning expectation. A lot of this money, the financing of some of their capex, is coming from forward orders, so it's not necessarily even going to be raised in the debt market. However, their capex spend came at $55 billion versus the expected $50 billion. Going forward, they're going to have to raise an additional $20 billion on top of what they had previously expected. Oh, and by the way, Oracle has $117 billion of debt in the investment grade index. That is the most for any non-financial issuer, and it has all come in the past couple of years. It is going to the moon in terms of capex expenditures at the same time that companies are pulling back on some of their AI budgets.
All of that ahead of the biggest IPO we have ever seen. Coming up on the programme, we'll catch up with Francis Donald of RBC as tech stocks find a firmer footing, Ed Mills of Raymond James on what artificial intelligence could mean for the midterms, and Mike Pyle of BlackRock as investors gear up for a record-breaking year of IPOs. We begin this hour with stocks recovering after hitting a 5-week low. Francis Donald of RBC writing, for the past 6 years, US consumers have borne the brunt of accumulating inflationary shocks. That chapter may now be ending. Francis joins us now for more. Francis, welcome to the programme. What's changing?
Well, the consumer is losing the capacity to absorb any additional shocks. That savings rate is down, real wages are now negative, and the capacity to absorb that has existed in the entire post-pandemic experience, we believe, is now fading. Now, that doesn't necessarily mean the consumer is going to collapse. There's a very strong top 10% consumer. It just means that you're going to get more resistance going forward on passing through these additional price shocks to the consumer. businesses are going to face harder choices, because if they continue to rely on the consumer to absorb these price shocks, they're either going to see the consumer say, no, thank you, some demand destruction, or you're going to see consumers that say, that's fine, but we're going to need higher wages. And that's why this tipping point is so critical and isn't necessarily reliant on your inflation forecast. It simply means that the psychology that has existed for over half a decade now in the macro environment may need to pivot, and we could see it as early as 3 to 4 months from now.
The backdrop you described, Francis, to me at least, listening to it, would make it difficult for any central bank to hike interest rates. Where does it leave Kevin Warsh and his committee?
Well, certainly very challenging. We're hearing a lot from central banks like the Bank of Canada yesterday about the policy dilemma of what happens when you have higher prices that weigh on growth. But to me, the real policy dilemma is that monetary policy is just not as functional and way more complicated when you have a substantial K economy. You have a top-end consumer that could withstand and probably needs higher interest rates. And then you have a bottom-end consumer that is going to go through some cyclical weakness and maybe even some structural weakness here. So how this central bank and what we hear from Kevin Warsh and how he thinks about this and this policy dilemma is going to be very important moving forward. Not just what action they take, but the philosophy around a growing divide within American consumers and how does monetary policy best serve them. I think an underappreciated question we should be asking Kevin Warsh.
Francis, do you think that the ECB could potentially hike rates even if the U.S. doesn't, because of the K-shaped economy, that there isn't such a market divide in the Euro region as there is in the United States?
Well, this is the differentiator between the United States, and there's a few of them. One is that big divide between that top 10% that has accumulated massive savings, massive amounts of benefits from financial markets doing well that we don't see in the rest of the developed world. That's true. But there's also a different growth dynamic that's happening here, which is the United States growth dynamic has been upheld by structural guardrails. The AI story, big government spending, that top 10% very wealthy consumer. But now we're starting to see a broadening of that growth dynamic in the United States. Now, some of it might be FIFA. Some of it might be some movement around tariffs, that IEEPA ruling coming down, some distortions. But there's enough happening in the U.S. economy right now that suggests that their economy is actually becoming stronger, while DM economies outside of the United States are suffering under the weight of this energy shock. So certainly how central banks choose to respond to that will be interesting. But the divergence occurring between U.S. growth, which is being allowed to run hot, and the rest of the world that is challenged with more of stagflationary dynamics is interesting, and also a new dynamic than what we've seen over the past 1 to 2 years.
Francis, you talk about the tipping point where either potentially you're going to start to see people pulling back because their savings are out, or they're going to demand higher wages and get them, is a really interesting one, especially as we get PPI later today. And you have heard about profit margins expanding at a number of companies. Why won't workers go to their bosses and say the number of tokens you would need to pay to do what I do is actually more than I'm getting paid, so pay me the amount that my tokens would be worth? I mean, why is this a value proposition not going to necessarily lead to higher wages?
Well, it's actually interesting. My team this week has all been talking about token use, the cost of tokens. Are we going to reach that moment where we say, actually, there is a cost of labor and there's a cost of actually substituting out of labor as well? This is critical. And the most important data that we're watching right now is what are companies planning to do with pass-through? So numbers like PPI are more important, small businesses' intentions to pass through, but also consumers' ability to absorb that. So the relationship between business costs, how they're using those very large corporate margins, and the choices around them are going to be critical. From transcripts to survey data, this is a moment to really zero in on, do businesses see the capacity to reduce costs in other areas, and do they have the capacity? Are they seeing any signs that they're going to have to slow through the pass-through? To me, that's the biggest Q3 question.
You talk about in your note how businesses choose to carry this will define the next chapter of the cycle when it comes to higher prices. Mohamed El-Erian has talked about this in the past. Listen to what the C-suite says. What are they telling you right now?
They're still talking about pass-through. They're talking about a slightly more fragile consumer, but particularly at the lower end of the sphere. So this is an early development. We're not quite there yet, but in our view, we only have a couple more months of savings with the consumer before you start to see that consumer start to break down. So as I said, Q3, Q4, watch for this transitional moment coming through. So far, surveys are saying, well, we're getting a little bit more cautious, but not quite there yet. Again, we really try to downplay soft surveys typically, but we're going to have to watch for some dynamic on that front more than we have in the past. It'll show up a little bit more before the hard data.
Francis, where's the savings coming from? I remember during Christmas, people were saying that the consumers are going out and they're spending their savings right now on, and also their higher tax refunds. And then it was early in this year, they're spending that on higher electricity bills. Now everyone's saying they're spending that on higher gas prices. Hasn't this dried up?
It has. So we have near record low savings rate right now. That's a flow type of story. And this is exactly why it doesn't matter whether you believe inflation has peaked or not. The stock of available consumption now is beginning to decline. If you go back several years, consumers had government transfers coming through from the pandemic. They had wages that were real in positive terms. They were accruing some benefits from that stronger stock market, but mostly to the top end. Those have now depleted. So again, we're not talking about a very bearish consumer outlook. There are still elements of strength. We are not talking about a complete collapse. What we're talking about is that the baton has to be passed on price pass-through from the consumer to businesses, because businesses are going to see it in real time that the consumer says, I do not have the capacity to continue purchasing. And there's been such a psychological focus. We've become so accustomed to this idea that as inflation and prices rise, from tariffs to geopolitical shocks, that they roll through to consumers with a lag. This is the point that we're trying to make, is that 6-year paradigm may be on the edge of shifting in the other direction.
Something we all need to watch. Francis, appreciate your time. As always, Francis Donald there of RBC with the latest. I was listening to you talking about the cost of AI, the price of it, the actual price of it, what it should be. And I was thinking back to that very clumsy line from Standard Chartered, which they've since apologised for, low-value human capital, and replacing so-called low-value human capital. Never mind the wording. Let's focus on the strategy. Maybe you have to dedicate really the compute to the high-value tasks. And with that in mind, you're really going to dedicate it to replacing what they consider to be the very clumsy line, low-value human capital.
The concept of value is going to shift, right? I mean, if you're essentially able to do the highly technical, structural calculations and programming that highly paid individuals used to do, does that lead to that being where a lot of the cuts come from? Increasingly, people are talking about how much tokens cost, and that's the reason why OpenAI is cutting prices, because they want to become deployed more widely. And if that's the case, maybe these advanced AI models aren't going to come for our jobs, because guess what? Maybe we're worth it.
That's kind of what I'm getting at,
yeah,
Ramo.
Maybe we're worth the money, because
sounds like a makeup commercial.
The amount. So buy your
You are worth
mascara.
It, You're so worth it.
You're worth
Maybe
it.
she's born with
yeah,
it.
versus the token cost, which, energy costs something, water costs something. I mean, I need to be fed as well, but ultimately my food might be cheaper.
Possibly. Let's get you an update on stories elsewhere this morning. So worth it. With your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The US carrying out a second straight day of strikes on Iran after President Donald Trump accused the country of dragging out peace talks. Trump telling Fox News the US will hit Iran again today if it doesn't sign a deal. Before the attacks, Tehran warning it would target new US assets if Washington took action. Anthropic CEO showing support for government regulation of AI. Dario Amodei writing in an essay, the government should have the power to block AI developers from deploying new models if they present certain risks. Amodei saying there should be mandatory testing by third parties. The New York Knicks pulling off a record comeback against the San Antonio Spurs to win Game 4 of the NBA Finals. New York coming back from a 29-point deficit to win by a single point. The Knicks are now one win away from their first NBA title in more than 50 years. Game 5 is on Saturday night in San Antonio. That's your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate it. You trying to go?
Yes.
Trying to get over there? Okay.
Well, I'm going to be in Houston tomorrow, so, it's very close.
Perfect timing, right?
Very convenient.
You guys have been travelling over the last week or so.
I just happened to be...
What am I getting wrong here?
Well, you can come. Use the increased margins go to something, John.
Okay. And your travel budgets, apparently. All right. Up next on the programme, cozying up to AI.
I'm going to have meetings with the top 12 or 15 executives very shortly. And we're talking about giving back something to the public. And if we do that, the public will become very rich.
Ed Mills of Raymond James joins us next, live from New York City this morning. Good morning. So here's the bounce this morning, up by 0.6 on the S&P, on the Nasdaq higher by 1 full percentage point. Just a touch of outperformance on the Russell, up by 1.2. The focus on tech continues. Under surveillance this morning, cozying up to AI.
I'm going to have meetings with the top 12 or 15 executives very shortly. And we're talking about giving back something to the public. And if we do that, the public will become very rich, the people in our country, because that's the kind of money we're talking about. And I think they'll do that, and I think it'll make it very popular.
So here's the latest this morning. The president continuing to tease unconfirmed meetings with AI executives. Artificial intelligence weighing on voters ahead of this year's midterm elections. A new poll by Reuters and Ipsos finding 53% of Americans worry the technology could cost them or someone at home their job. Joining us now is Bloomberg's Tyler Kendall from Washington. Hey, Tyler.
Hey, John, good morning. Well, how to balance the potentially massive gains from the AI boom with the potential risks is increasingly becoming a focus here in Washington. Yesterday marked the second time in less than a week that President Trump expressed an interest in the U.S. government taking equity stakes in AI firms. He seemed to suggest that he's already had some of these conversations, though declined to give specifics or how exactly this would work, though a person familiar with the matter does confirm to Bloomberg News that OpenAI CEO Sam Altman did float the idea of government stakes in AI companies to the Trump administration back in early 2025. But more recently, Altman was just on Capitol Hill last week meeting with lawmakers on both sides of the aisle after Senator Bernie Sanders reignited the idea on Capitol Hill, floating a new proposal that would see the federal government levy a one-time 50% tax on AI companies paid for in stock and kept in what he called a sovereign wealth fund that would seek to redistribute the gains to the public. It's all taking on this new urgency as we get closer to November. And you mentioned the jobs market, but John, we also saw this Reuters Ipsos poll go on to cite concerns Americans have when it comes to rising energy costs. The survey found that 77% of Americans feel that AI will make their electricity bills go up. Last week, I met with 10 of the U.S.'s top electricity CEOs, all of whom told me that energy and affordability is the #1 issue that they hear from the public.
Heading into the midterms, heading into the general, only a few years away. Tyler, thank you. Tyler Kendall with the latest in Washington. Ed Mills of Raymond James writing the following. If Democrats win a House and or Senate majority, expect calls for federal laws limiting data centers to be near the top of the agenda. Ed joins us now for more. Ed, welcome to the show. It's good to see you once again. Let's focus on this. How are things changing heading into the midterms?
Well, we've argued at Raymond James that AI policy is probably the biggest market event from the midterm elections. You go back to last November, John, Democrats did really well in Virginia and New Jersey, arguing that energy costs are too high, arguing against data centers. You're seeing Bernie Sanders against it. You see Hakeem Jeffries, the Democratic leader in the House, saying this will be a priority. They're trying to make those data centers the Death Star to the American public and say that's the problem, and then build upon that, trying to have new hawkishness on China and a whole bunch of new AI policies, trying to kind of wrap this against Trump and against Republicans, especially if they win a majority. That's going to be the market concern.
Ed, what's actually going to be the policy when it comes to what some conservatives and free market individuals are saying that this government is trying to nationalize some of these companies?
Yeah, well, this has been a weird push-pull, Annmarie, because there has been a general angst about kind of government stakes in U.S. companies. But with President Trump, he's had the support of Republicans in Congress because they generally support him. I do look at the AI export program that should have some of their first announcements this month, which is going to get some government financing to back AI programs around the world. Maybe we take some of that financing that we're promoting and supporting some of these hyperscalers and using that as the hook to get that equity stake. I don't think we have that proposal that Bernie Sanders talks about. That would require congressional action. That's not going to happen. I do think that because Donald Trump has created this precedent, Annmarie, it is more accepted than it otherwise would have ever been.
Absolutely. He's also talking about a meeting that is unconfirmed, hasn't taken place yet. Why is he doing this? I mean, the AI companies are saying there's no meeting right now. Why is he just putting this out there?
Well, Annmarie, he loves to be at the center of the most important debates to the extent that he can be on the world stage with Putin or Xi or with the leaders of AI, especially as we're seeing some of these major IPOs in the pipeline. Inserting himself into that policy is really important. Secondly, recently we got an AI executive order, and we're seeing a massive policy shift with President Trump, where at the beginning of his term, he did away with the Biden executive order that looked at things through a national security lens. He's starting to do that as well, and he's starting to engage here because he's not quite sure if the free release of these models is the right policy, or should we have a government review. The more that he gets concerned with that, the more he's going to want to meet with these AI executives, the more this becomes a political problem, the more he's going to want to insert himself into that, trying to neutralize that policy.
Ed, to that point, is President Trump leading the charge for Republicans in terms of supporting AI development, or is he offsides with some of his Republican colleagues who are very concerned about this, hearing from their constituents and looking for more regulation?
Lisa, it might be both. We've seen kind of a huge push at the beginning of this administration to change some of the policy towards China, making an argument that unless we get these leading edge chips to China, China will develop their own. We had the DeepSeek moment. Then he started to say, all right, we could allow China to get more chips, the H200. Those haven't been developed, or they haven't been sold to China at the levels he thought they would. And then on Capitol Hill, that's where you've gotten the pushback. We've had introduction of legislation, the Match Act, that has already cleared committee on a pretty decent vote that would restrict some of the semiconductors going to China, would restrict some of the semi-cap equipment going to China. And Republicans are telling him, you have gone too far in easing up some of these restrictions. We don't like the fact that you've merged the national security and economic lanes. We understand that we need to win this AI race, but giving it to China, being too fast and loose on some of the national security issues, that is a concern for us, especially if this is kind of getting deployed in the way in which we hear a lot of folks in the market talk about it.
Ed, there's also a concern about the personnel and the brain trust close to the White House right now. There have been a number of departures, Thomas Lind, the most recent one. Is that concerning given how quickly this is moving and the need for expertise to understand how it's working and what exactly the potential applications, potential danger, potential benefits could be?
Yeah, we have a lot of turnover in government as a general source. It has been a uptick lately on some of the AI policy individuals. I've talked to a number of them after they have left or kind of when they've been doing these things. I've actually been relatively impressed with the AI policy infrastructure that he had put into place. And I do think the fact that we had an AI action plan that came out pretty early in the administration, now we have an AI executive order. It's been an area that they've been focused on. Let's see what that staff gets replaced with. But so far, it's been pretty robust. And when I've talked to that staff, one of the things that they've told me is, A, they want to flood the zone. They want to make U.S. technology the default technology for the world. And just as the dollar is the reserve currency of the world, they want that U.S.-based token to be the reserve token of the world. And that's why they're trying to export this globally. If they win that, they tell me that's the most important national security issue that they can actually achieve in this administration. So I'm hoping they're right.
Ed, thank you, sir. Appreciate it. Ed Mills there of Raymond James. It's not a great message, is it? We're going to take your job and push up the price of your bills. Public's not going to be happy with that.
They aren't happy with it, which is why Ed said it's going to be the key issue heading into the midterms. A lot of people agree with him.
Coming up on the programme, we'll catch up with Ted Mortonson of Baird as Wall Street awaits the SpaceX IPO. Plus, Yahya has your morning movers. Check out Intel this morning. Shares rising on a double upgrade from Bank of America. The stock is up by more than 4%. Two-day losing streak on the S&P 500. Your bounce looks like this. Up by 0.6 on the S&P, up by 1 full percentage point on the Nasdaq. Some wild swings once again for chip stocks. 10 percentage point range on Tuesday, on Wednesday, something like a 5 percentage point plus range. for chip names once again. Volatility starting to creep into this equity market heading into these IPOs.
It is volatility. It isn't a wholesale sell-off, and that's the point, is that people are still bullish. They still think that chip makers are going to do well. So if you see a dip, it's buyable, and that's essentially what we see every single time. Whether the same story can be told about hyperscalers increasingly will be the question, as those CapEx budgets, the wealth transfer from one to the other, chips being on one side and hyperscalers on the paying side, continues.
A major wealth transfer funded by you and I in this bond market, this equity market too. Not so much me, but you at home, of course.
Us too. I mean, if
Right.
you have a 401k, you're paying for this.
Yes, without a doubt. In the bond market right now, you're gaining on the chip side too if you hold them. Anyway, fixed income, go, bonds, 2s, 10s, 30s.
Focus.
Let's get into this. Inflation data coming in line with expectations, helping to stop the rot in the bond market just for now. We're down 4 basis points on 10s, 451. The next stop for this market, there's a mix of things in the next hour. ECB rate decision in the mix. Remember, what can move the European bond market can move global bond markets. PPI data, jobless claims, 2 big data points, 8:30 Eastern time.
Yeah, and we heard from Frances Donald at the start of the hour. We could see PPI come in. You were mentioning 6.4% is the median estimate, which is a shocking number. She said this is going to get more and more important. Can some of the companies continue to pass along the costs given the savings rate? Do companies either start to pay their employees more, wage price spiral, or do consumers start pushing back and say, we will not buy it if the prices go up that much? Margin compression, that's going to be a problem for the stock market and growth. We're at that tipping point.
We are, and it's a big call that needs to be made over at the Federal Reserve with Kevin Walsh and that new leadership. Is this labour market tight enough? Does it have strong enough momentum to worry about the prospect of wages picking up? Which sounds crazy to say out loud. As I've said a few times, the only people that worry about higher wages, economists. But anyway, park that conversation for now. Run with me. Distracted this morning.
We all are.
I mean,
it's a Dix effect, yeah.
The market should have been closed today. I'm sorry.
All right.
Did they have to worry about the labour market in the same way they used to? Back when we had unemployment around 3.5% and inflation picking up. The last time we were at 4 on headline inflation, we had unemployment in the mid-3s. That was why rates were so much higher in the 5s compared to the 3.75 we're at right now.
It's hard to get a real read on the labor market, and this is why initial jobless claims will be interesting, although they haven't been very interesting for the past couple of months because they've been basically flatlining. At the same time, people are looking at the labor market data and painting completely diametrically opposed ideas. On one hand, you could say you are starting to see slack in certain areas. Take a look at wages earned and the fact that they're not keeping pace with inflation. On the other hand, look at JOLTS data. Look at the job openings data. Look at the anecdotal commentary coming from headhunters saying that actually you're seeing a reacceleration and a broadening out in some of the labor market gains. Pick your poison. Right now it's really uncertain.
Lisa talking to headhunters. Do you notice that?
Yeah.
Yeah, crept into conversation. Just slip that out.
Just slip that in.
Just letting you know.
What they're saying,
letting you know. Becky Frankowitz, we all talk to her.
Okay.
I mean, we all talk to these people.
Sure. Right there with you. All right. 2 hours away from the opening bell. Let's get some morning movers. Yahya has more. Hey, Yahya.
Hi, John. Despite another quarter of massive AI growth, we are seeing Oracle shares now down nearly 8% in the pre-market after the company said that it will spend more to build AI data centers. But that came as Oracle left its revenue outlook largely unchanged, just leaving investors wondering where the payoff is amid all that additional spending. Meanwhile, as you mentioned, we are seeing the chip stocks bounce back today, but Intel is getting a major boost from BofA. They double upgraded the stock, arguing that investors may be underestimating its growth in its chip server business as well as its foundry. They also say that Intel remains under-owned compared to its peers, leaving room for investors potentially to pile in. And we end on the space stocks. They are rebounding after a recent pullback. So you're seeing names like Rocket Lab up 4% in the pre-market as we count down to tomorrow's historic SpaceX IPO, set to be the biggest ever with a $75 billion raise. As for what comes next in the IPO process, we're waiting to see how shares are allocated, with reports, including from us, that demand is far exceeding the number of shares available. John.
Yahya, thank you. Thanks for the update. More from Yahya in the next hour. On our radar this morning, Oracle shares falling. The tech giant reporting capital spending plans well over estimates. Oracle expecting CapEx for the fiscal year to total $70 billion, fueling fresh concerns on AI profitability and the amount of money being spent. Oracle is down by 8%. in the pre-market. Elsewhere, SpaceX playing hardball with Wall Street ahead of its $75 billion IPO. People familiar with the matter telling us here at Bloomberg that firms including Mizuho and SocGen have been handed minor roles with fewer fees and bragging rights. And finally, Anthropic CEO Dario Amodei calling for stronger government oversight over AI. Amodei arguing regulators should be able to block developers from deploying new AI models if they pose risks to the public.
Especially if those risks stem from OpenAI, say, or XAI, or some of these other AI developers that potentially could have problematic models versus the Anthropic models, which are probably on the up and up. Look, on one hand, we mock. There are two ways to understand this. There are many more than that, probably. But the way that I'm trying to understand this is there truly a risk that somehow some of these models are going to go full Star Wars and start upgrading themselves and then taking over the world, which is the fear that some people have? Or is this a competitive edge that they're hoping to keep, the moat around their particular software, their particular large language models that could potentially give them a edge with the likes of OpenAI?
Or is the writing already on the wall? So you put out a letter like this because you want Washington to come and deal with you as opposed to everyone else as you try to write this regulation. In this letter, he says the best analogy in the current stage is comparing it to cars, airplanes, drugs, powerful technologies essential to the modern economy, but capable of killing large numbers of people if designed or operated poorly. Maybe they just want to get in on the ground level as the government begins. The government's going to have to regulate this. They're going to have to. The pushback in the midterm elections in 2028 is going to be severe.
That's the kind of regulation and taxes they probably won't like. Tech stocks looking to rebound after hitting a 5-week low ahead of tomorrow's historic SpaceX IPO. Ted Mortonson of Baird writing the following: the capital pull is large enough to pull some capital away from tech winners. Ted joins us now for more. Ted, it's good to see you, sir. Welcome back to the program. Do we have space for all this equity?
That's the million-dollar question. I mean, Oracle last night just popped $70 billion. If you look at Anthropic, you look at OpenAI, you look at SpaceX, it's a big number. So portfolio managers are now struggling on how to allocate these new offerings going forward.
Ed, what are your thoughts? Ted, what are your thoughts on how we should deploy some of that capital from here? Should you be buying some of these names? Should you take it away from the winners, the guys that have been running up so quickly over the past few months?
I think this cycle is so powerful that you have to be involved in these. It's just a matter of how much and what the timing is. And I think from my standpoint, other sectors that don't have this macro associated with them, they need to be drained a little bit. And portfolio managers have to get into these names just because the forward weightings are going to be so dynamic that if they don't play, they're going to underperform.
Let's get a little more specific. Is there room for OpenAI and a potential IPO, given the fact that they're cutting prices to get some of the customer base of Anthropic?
My opinion is yes. If you look at what's happening just on this cycle and the amount of infrastructure pull-in, the software area is going to go along for the ride. Probably not up front like the infrastructure is, but over the long term, you're going to see a lot of free cash flow generated from these next generation software companies.
Do you think there's going to be a bifurcation? We were talking about this Citadel note just moments ago, where they're talking about a bifurcation where you've got the frontier AI concentrated among a few firms with balance sheets that are big enough to absorb it. And then you have others looking for commoditized models that are cheaper and can perform more basic tasks. Do you think that that's the world of AI that we're going to be living in for the next year or two?
I think it's going to be very, very volatile. It's very hard to put your finger on how these models are actually going to settle out. There is a fair amount of deflation going on as it relates to models. If you listen to Palantir, for example, also on token pricing, I think we just got to let it play out and versus speculating. The macro, though, from a AI stack perspective, is so disruptive that I think we've got to look at it more from a long term and react to the models as they materialize.
Ted, you rightfully point out in your note that tech CEO messaging is out of touch with 80% of the population. Is that why we have this letter overnight from Anthropic?
I think so. I mean, I wish some of the tech visionaries would really define not how their companies are doing, but how AI will affect humanity in a positive way. whether it be productivity or instead of job loss, job expansion. I think when you look at the bottom 70% of the population, they're getting hit not only on inflation, but I think there's an angst that AI could control their destiny from a work and quality of life issue. And this is happening so quickly that I think that leadership has to take it under their wing to actually communicate to that bottom 70% and not the top 30%.
How are you thinking about what the U.S. government is going to do, especially when President Trump is talking about maybe he does line up with Senator Bernie Sanders and they should be taking equity stakes?
Oh boy, that's a loaded question. I'm not a big believer in government choosing winners and losers. I think there's going to be some mechanism that if AI does materialize in a way that we are projecting, that the bottom 70%, if you will be taken care of. I think it's conjecture at this point on what that model looks like.
Ted, I just wonder if we can turn that round just a touch. The government picking winners and losers. There is a loser right now, and it appears to be OpenAI, and they're picking the government. And Ted, I just wonder why, and I'm trying to work that out. What are they getting at here? There's been this talk reportedly in the last year as well, that they were talking about some individuals in the C-suite that maybe the government should be involved to support any potential losses because this is getting too big to fail. Ted, how do you think about that dynamic?
I tell you, it's moving so quickly that to be honest with you, Jonathan, I don't think anybody really has, the real view here. I think there's got to be a lot of discussions, company to company and with the government to figure this out. It's moving so quickly and it is so disruptive that, quite frankly, I don't think anybody really has the answers. I think we're trying to nail an answer that may not exist right now because of the pace of innovation. I think it's gonna play out over the course of the next couple quarters, and I think we just have to go with how the market develops and, quite frankly, how we make the country as a whole function.
Hold on tight. Ted, it's good to see you. It's always great to catch up. Thank you, sir. Ted Mortonson there of Baird on the relationship, developing one between the government and these massive tech firms.
Yeah, his take is it's just we don't know. And this is developing so quickly. I was speaking to one banker who said that he's been through several of these industrial revolutions and so the internet and some of the other sort of industrial build outs. He said this is completely different because we don't know the end point. We don't know. I mean, I joke about full Star Wars, but we don't know whether this is going to become autonomous in some capacity, whether it's going to be able to replace us, whether we're going to be in space, working on the data centers that are fueling, the robots on Earth. I mean, it sounds existential and sort of pie in the sky, but
in some ways it is.
That's essentially what people are talking about. They're literally doing an IPO to do just that.
Well, you hear lots about the railroads, right?
Right.
But at least you know you were building something to somewhere.
Correct.
Not sure if that's the case this time around.
We don't know what the ultimate goal is. Is it to automate all of the work? Is it to create a better future for the 70% of people who aren't going to have jobs? Is everyone going to be more employed and doing more interesting, fulfilling things? Will we all have more time to take off to go to Rio? I don't know the answer to this.
And watch sport.
Exactly.
Stay up late and watch the Knicks, which is what everyone seemed to do last night.
Clearly.
Saw a great clip of Taylor Swift, right, getting all excited, and there's a guy in the background. There's a great tweet out there, post-X, whatever.
I saw this.
And it says, don't know who she is, but I know Paul Tudor-Jones when I see him. Sat right behind her.
I saw that, yeah. It was definitely a who's who. Amazing. Finance right behind.
Gotta love a finance pro, right?
Great.
Let's get you an update on news worldwide with your Bloomberg brief. Bonnie Quinn has more. Hey, Bonnie.
Hey, John. Thank you. OpenAI is gearing up for a war with Anthropic users. The Wall Street Journal reporting the company is considering drastic price cuts to win customers from its rival. The Journal is saying price cuts could potentially erode the profit margins of both companies. UK Defence Secretary John Healey announcing his resignation just moments ago. In a post on X, Healey citing Prime Minister Keir Starmer and the UK Treasury's inability to commit suitable resources to the country's defence needs, he says, during a time of rising threats for his departure. And as we've been saying, the New York Knicks pulling off a record comeback against the San Antonio Spurs to win Game 4 of the NBA Finals. New York coming back from a 29-point deficit to win by a single point. The Knicks now just one win away from their first NBA title in more than 50 years. Game 5 on Saturday night in San Antonio. And that is your Bloomberg Brief.
Just very cool for this city. Fonny, thank you. Appreciate it. Up next on the programme, the SpaceX IPO countdown.
AI is the biggest technology. Everybody's investing in it.
There's going to be selling in a lot of other technology stocks as we get these IPOs.
The need for liquidity is massive.
Up next, Mike Pyle of BlackRock, live from New York City. You're watching Bloomberg TV. Tempted. Really tempted.
No, just please, come on. Let's
really
move on.
tempted.
Please,
don't do that.
Come on.
Okay.
We're friends here.
All
We're
right.
family.
I'm not going to out you. Everyone wants to know, but I'm not going to.
Good.
Equity futures right now positive. Still tempted by 0.7.
Move on.
The S&P and the Nasdaq up by 1.2. Under surveillance this morning, the SpaceX IPO countdown.
AI is the biggest technology that we've seen probably in our lifetime. Everybody's investing in it.
There's going to be selling in a lot of other technology stocks as we get these IPOs.
As long as the capital markets remain open to these really massive market caps, that's the opportunity.
The need for liquidity is massive.
I'm just going to say, and you can decide who it was, that someone around the table thought Scottie Pippen was a New York Knick back in the day. Just throwing that out there, all right?
I think we're talking about IPOs right now.
It's the latest this morning. Wall Street bracing for the record-setting SpaceX debut tomorrow. According to data compiled by Bloomberg, the expected list of mega IPOs could add nearly $4 trillion in market cap to US exchanges. Mike Pyle of BlackRock writing, the key question for investors is who can sustainably finance the AI build-out over the next decade while converting that investment into durable cash flows. Mike joins us now for more. Mike, good morning.
Great to be here.
It's good to see you, buddy. Let's talk about how much money is being issued right now, how much money is being raised, how much equity is being issued, and what we could see over the next year or so. How this market's going to make space for it in the next 12 months.
Yeah, I mean, I'd start kind of where you did, which is just the scale of the capital raises here. And I think one thing it highlights for us is, of course, companies are staying private longer. Of course, private markets can finance a depth of investment in a way that they haven't been able to in the past. But at some point, public markets are still required to finance capex of this scale. And moreover, to the point you highlighted on screen, the duration of capital that needs to be deployed here. This is going to be a marathon, not a sprint. Like financing this build out and then the ability to turn that into cash flow that's going to pay off for investors. That's a kind of multi-year phenomenon, and it's really public markets that ultimately are the place where that capital raise can be made.
Are you seeing big enough signs of pushback to worry that things are turning?
You know, listen, I would say we believe very much in the AI thesis as a key part of investors' portfolios over the medium to long term. There's going to be, volatility along the way. We've certainly, seen that over the past couple of weeks, even with some of the big winners pulling back a bit and then stepping forward again. And, I think the important thing is for investors to have AI exposure in their portfolio that's balanced, that's well-sized against the totality of their portfolio. But that's like the key thing that we're advising investors is take a look at the whole portfolio, take a look at your AI exposures as a whole, and be sure that those are sized appropriately given the goals you have.
Do you have to see the rest of the economy start to catch up for the profitability of some of these AI companies to continue increasing at the pace that they have been?
Yeah, I mean, I think that you're seeing a pretty extraordinary pace of deployment of AI tools. I do think that, the conversation is shifting across corporate America from one that has been focused on speed and pace of deployment to, where are we getting value for money? How are we going to be disciplined on cost to ensure that the tools that we're paying for at different price points are delivering return on investments that we see in terms of reduced costs, in terms of enhanced revenue. So I do think the conversation is shifting. I do think we have confidence that, again, over that medium to long term, we're going to find a place where these tools are really driving productivity productivity in a meaningful way, and that's ultimately going to support the sector as a whole.
I guess what I'm trying to get at here is, are we at an inflection point to a stronger economy and a stronger labor market as productivity generates more growth and people's ability to request higher wages because guess what? They're worth more than the tokens that they otherwise would be replaced with, at a time when potentially inflation is running a little bit hotter, where capital markets are wide open, and where there's a Fed that seems to be pegged on pause. I mean, is that the scenario that you're expecting?
Yeah, so I think the Fed clearly has a pretty complicated dynamic that it's facing. Chair Warsh is going to face coming into office, and I think you highlight the key pieces. I mean, inflation, as we saw yesterday, on the core reading, maybe a little better than expected, but I think there's some underlying pieces that are sticky and are likely to be. And moreover, when it comes to tariffs still being part of the picture, when it comes to energy clearly being a part of the picture, and importantly, when it comes to this AI story, over the medium to long term, we think that's productivity enhancing. We think that that's disinflationary. But in the here and now, that's putting upward pressure on prices, upward pressure on capacity utilization. One of the stats I've been citing is, hyperscaler CapEx plans have gone up by about 30% since the start of the year. About half of that is increased volume or increased unit economics from the AI build-out. About half of that is just increased prices. So I think that highlights that they're really climbing up a pretty steep part of the supply curve and just underscores that there's a lot of pressure in this economy, including increasingly from labor.
Mike, what do you make of the potential government intervention, especially given the fact that you were part of the Biden administration when there was a proposal to make some sort of sovereign wealth fund, especially when it came to focus on national security interests?
Yeah, so listen to the interview with the prior guest. I think really identified with what he would say. I would observe, it is clear that AI is a issue that the American people are paying increased attention to. It is rocketing up the list of issues voters have their eyes squarely on. Moreover, I think skepticism, it's fair to say, looking at the public opinion polling data, is pretty significant. What does that add up to? I think it adds up to a world where this is a topic that policymakers, the politicians, are talking about a lot in the coming years, and there's very likely to be, I think, some meaningful policy steps in this space. I think his core point was the cone of uncertainty on what those policy steps might be, I think, is incredibly wide. And I don't think it's possible to really venture a guess as to where this is going to land, other than to say this is going to be a first order issue and there's going to be, policy action.
I think you can work out the reaction on the left, which is tax and redistribute. It's the reaction on the right that I'm more intrigued by. Not the populist right. I think they have more in common with the left. Lisa's talked about that extensively. More the conservative right, which typically would embrace creative destruction. Are they going to be able to do that with a technology like this that threatens to take people's jobs?
Well, we spoke recently to former Vice President Mike Pence. He was definitely not in favor of U.S. government taking equity stakes of any company. And he said also he believes in lower taxes. So I think you're going to have a real divide within the Republican Party.
I love the take from markets, which is essentially, this is great. Any regulation coming down the pike, so good. It's actually a bull case for the investment because the data center that I built today won't have as much competition tomorrow. And that essentially is the take from Wall Street, which is like, throw it at us.
Stop us from spending, please.
Yeah. Well, throw it back. Just stop the other models. We're good.
Mike, it's good to see you. Thank you, sir. You stay up late last night?
Might have.
A little bit, yeah. You're not alone. Mike Pyle there of BlackRock. Thank you, sir. Appreciate it. Coming up next, Savita Subramanian of Bank of America, James Athey of Marlborough, and RIchardson of ADP. Up next, an ECB rate decision. That decision about 20 minutes away, and inflation data, more of it. PPI and jobless claims about 35 minutes away. From New York, you're watching Bloomberg TV.
There are a lot of non-fundamental factors that are going to interfere with markets and cause volatility.
The market is finite, and we've already seen some volatile days.
It's a little white knuckle moment that we're going through in tech.
Liquidity is the most important factor for these markets to keep on rallying.
I think this year we have the chance that we beat earnings nicely.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores, the price action, shaping up as follows. We're up by 0.75% on the S&P, higher by 1.2%. On the Nasdaq, on the Russell, up by 1.4%. In the bond market, yields declining across the curve throughout much of this morning. We're down by 2 basis points on 2s, down 3 to 4. On 10s, heading into this 30 minutes away, PPI data at 8:30 Eastern time alongside jobless claims in America. Before we get there, at 8:15, we're gearing up for a rate hike at the ECB.
Yeah, 70 basis points of a rate hiking ahead priced into the market right now for the European Central Bank at a time where growth is running below where it is in the United States, at a time where inflation is expected to peak out soon and then come down, at a time that doesn't have the growth engines in the places like Europe that the U.S. has with the likes of artificial intelligence. Will this be a policy error, or will this be the required step to support the euro at a time when there are a lot of questions about why you'd want to invest in that continent?
Should we talk about the U.S. data as well?
Please.
PPI 6 handle.
Yeah.
That's what we're looking for. CPI to 4 handle. Kevin Walsh is coming up in about a week. Tough spot for him to be in.
Ultimately, we'd be looking at the highest level going back even beyond with CPI to 2022, right before the Fed really engaged with a massive rate hiking cycle. Right now, remember that the Fed has just completed 3 rate cuts. And ultimately, Fed Chair Walsh is going to have to convince us that it's enough just to remain on hold, because that ultimately is the most hawkish that the market is expecting, but the market is pricing in right now some rate hikes.
Well, maybe he got an endorsement yesterday to remain on hold from the President of the United States. I was shocked that the President decided to say these words into a midterm election year. Quote, "I love the inflation."
What did he mean by that?
Well, I'll tell you. You know what I really love? I love the inflation. You know why? Because as soon as this war is over, you know I can say it now. You know we've been taking out 1 million barrels of oil. Nobody knows it. You know who doesn't know about it? Iran until now. Basically saying he likes it now because it sounds like it's worrisome for the Iranians, but as soon as the war's over, it's going to drop. I thought maybe when I first saw that headline, he was talking about core. And I was like, okay, he's giving a more nuanced approach to his inflation data. That is not the message you want going into November.
Politics doesn't do context well. That's going to get clipped. And it's going to get replayed again and again and again into the midterms.
People hate the inflation. The savings rate's going down. People feel it every time they go to the grocery store. They see it in their airplane tickets. They see it when they go to fill up their gas tanks. Ultimately, you're right, nuance doesn't play. It also is the tipping point that we're talking about. Either wages have to start keeping up or people are going to pull back spending. And right now, real wages have been declining at the fastest pace going back to 2023.
If you're in stocks, you're doing okay. We're high by 0.75%. We're bouncing back in the equity market this morning. Coming up this hour, we'll catch up with Savita Subramanian of Bank of America, warning of too many red flags for equities. James Athey of Marlborough as the ECB gears up for a rate hike, and RIchardson of ADP on the latest inflation data. We begin this hour with stocks shaking off another slide in tech as Wall Street awaits the massive SpaceX IPO. Savita Subramanian of Bank of America with a near street low 7,100 year-end price target on the S&P writes the following: red flags have emerged. Take profits. Savita joins us now for more. Savita, good morning. Good to see you.
Good morning.
Let's get to those red flags. Are they building, and what can you identify this morning?
Yeah, so we have a list of 10 things that that generally happen before the market peak, and these triggers have been sort of toppling over like dominoes slowly. So in March we saw 4 out of 10 triggered. By May last month we had 7 out of 10 triggered, and I think what worries me is that we're at the point where the stuff you generally see ahead of market peaks has happened. 70% of these bear market indicators generally get tipped before your average bear market that we've seen over the last 10 or 20 or 30 years. So that's one thing to watch. I think what's interesting is there still is a lot of cash sitting on the sidelines. So I think that's what gives me some solace that it's not like prior cycles where everybody was all in all equities and there was not a lot of dry powder on the sidelines. That said, what we've seen in the market is really just a very strong speculative bid. So a couple of things to note. Long-term growth expectations for earnings are the highest we've seen in a couple of years, and they're approaching all-time highs higher than what we saw during the tech bubble. So speculation is alive and well. Expectations are very high. And this really sets up the stage for disappointment. The second thing I would look at is just the performance. So high PE stocks with lofty expectations have massively outperformed low PE stocks. And this is generally not what you see in the market, and also signals a little bit more of a speculative bid that's taking place. Other things that we've talked about on the program already, I think the consumer is in an odd spot. We're seeing higher paying jobs on pause in terms of demand because of AI. We are seeing a bit of an uptick in wage growth for that lower income cohort. So I think that's the other bright spot, and one of the reasons that we still like consumer staples over consumer discretionary. But I think we're in a tricky market environment, and you really got to pick your spots.
One headwind I want to talk about with you, because I think you've been out front on this particular issue, talking about this earlier in the year when it wasn't really on the horizon for many, the tidal wave of equity supply.
Oh, yeah. Supply.
How much space do we have with it? That's a question we've repeated throughout this week.
Yeah. I mean, I think what's unnerving is that in one sector, the biggest sector in the S&P, the hyperscalers and tech, you're seeing buybacks slowing, you're seeing issuance increasing, and you're seeing new money coming to market. So that's all great in terms of, kind of new, exciting, shiny issues. But I think that what that means is this shrinkage story that we've enjoyed for public equities for such a long time is starting to ebb rather than flow. I don't think it's the end of the world, but I do think it's something to watch when we think about the drivers that have created this wonderful bull market that we've enjoyed over the last, 10, 15 years now.
So people would argue that the reason why shrinkage worked was because we were in a period of secular stagnation. And some people are arguing, PIMCO in particular, that we're emerging from that into a stickier inflation environment with higher growth and higher inflation. And in that scenario, some of these valuations can continue climbing, especially when overlaid with a technological revolution. How do you rebut that?
I mean, I think that might be true over the long haul, but I think in the near term, it could be a little bit complicated. So let's think about what works in a high GDP growth, high inflation environment. It's usually cyclical companies. And when you look at the weight of cyclical companies in the S&P 500, pretty small. So I'm bullish on manufacturing, cyclicals, that whole cohort, but I don't know if they're big enough to kind of drive this market meaningfully higher over the next 12 to 24 months. And then when I look at technology, I think what's getting a little bit trickier is there's a lot of competition now for, what's the best AI play. And we still don't know exactly how this will be monetized, how it will affect consumption. So I think those are some of the questions we need to answer along the way in order to say these multiples can stick. I also think, just real quick, the leverage and the issuance that we're seeing is moving in the opposite direction than what we want to see. So, the one selling point of the S&P 500 after the global financial crisis was all these companies paid down debt, they had solid balance sheets, and that's starting to reverse, especially for technology and some of these growth areas.
Can you see a broadening out? So it might be an underperformance of tech, an outperformance of some of these other areas that have lagged behind.
Yeah.
Can you see that without rate cuts? Can you see that with even potentially a rate hike?
Sure. I think we could see a broadening out with a rate hike. I think that it would be in areas that benefit from higher nominal GDP growth and higher inflation. So we love energy. We love materials. Real estate, I think, could do okay in that environment. I think the worst place to be in this scenario is cash. Cash real yields are terrible right now. If we get a hike, it means that they're still going to be terrible because we're hiking because of inflation. So I do see money, the opportunity to deploy cash in areas like large cap value, dividend income plays where you're protected against inflation, but also have, this growing cash return component. I think that those are the areas that we really want to focus on going forward. And if you look at what worked during the 70s and 80s, large cap value crushed it. We had a market environment where high dividend yielding cyclical companies like energy, materials, inflation protection really worked. And I think that might be where we go. I think energy is seen as just a hedge against geopolitical risk, but I think it's a lot more than that. We're in an environment where power is the bottleneck for AI. And that means we're going to be doing a lot of moving things around. We're going to be doing a lot of building. That is bullish for commodities writ large. And I think that's where we really want to think about angling our exposure.
Savita, good to see you.
Great to
see you. Just fantastic read. Appreciate your time. Thank you very much. Savita Subramanian there of Bank of America on the red flags in this market and a reason to take profits. Equity futures right now up by 0.7% on the S&P with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Oracle falling in the pre-market after reporting about $70 billion in net capex over the next fiscal year. The software company also announcing plans to raise another $40 billion in equity and debt next year, 2027. Senator Elizabeth Warren calling for the SEC to delay the SpaceX IPO. In a letter to SEC Chair Paul Atkins, Warren saying she's worried about the company's stock valuation, governance structure, and the potential impact on millions of Americans who will be forced to own shares in their retirement accounts. An historic moment in sports, the New York Knicks making the largest comeback in NBA Finals history, overcoming a 29-point deficit to beat the San Antonio Spurs in Game 4. The Knicks looking to win their first championship in more than 50 years on Saturday in Texas. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you for the update. Up next on the programme is the rate hiking cycle about to begin at the ECB. We'll catch up with James Athey of Marlborough.
The place you want to be is on the chip side of things because it doesn't seem like there's any end as far as some of the spending goes. And when you kind of look at some of these IPOs that are going to come out here over the next couple of months, I mean, clearly all of those proceeds are going to be reinvested right into that AI infrastructure build. Again, the place to be continues to be semis.
That was Angelo Zino of CFRA. On the latest equity market moves, stocks positive this morning, up by 0.75% on the S&P 500. On the Nasdaq 100, up by 1.2%. And the Russell this morning up by 1.3%. That's the equity market story. In the bond market, going into this ECB rate decision just around the corner, yields are lower by 2 basis points on two stateside, on 10s 451.65. Big focus will be on euro dollar going into this one, Bramo, looking for a 25 basis point hike from the ECB.
Yeah, key question will be how is message going forward? Is this going to be part of a rate hiking cycle, or is this going to be a one and done with a let's wait and see and be data dependent? Ultimately, we heard from Ian Steely that he thinks that if the Fed is more dovish, a one and done, that it would actually be really punitive for the euro. Other people think potentially it could torpedo growth with a rate hiking cycle, and that could be a problem.
Well, there's that rate hike, 225 on the deposit facility at the Eurozone. At the European Central Bank, the ECB deposit rate at 225. Could do that breaking whoosh now. Breaking news. No, not breaking news. All right. We were looking for 225. There we go. Let's catch up, guys. It's happening. Euro dollar 115.35. Widely anticipated. Maybe not breaking news for many people out there. It's the next move in the guidance that we're looking for.
Yeah, and right now the ECB is saying that they're not pre-committing to a particular rate path. So over to you, Christine Lagarde, to get a sense of whether there is any kind of signaling the ECB to consider incoming data, core inflation transmission, and committed to ensuring a 2% inflation rate. Do they take some of the rate hikes that are being baked into the market off the table right now? Not seeing much of a response from markets because they don't know what to make of this.
Ollie Crook in Frankfurt, Germany, tracking the decision. Ollie, widely anticipated. We got the first move. The focus today is about the second move and maybe a third. Are we going to get a second and third?
That's absolutely right, Jonathan. There's a lot of consensus going into this that this is what it's going to be. And there you have it, the ECB, the first major central bank to hike rates in the wake of the Iran war to deal with that inflationary shock coming out of it. The 25-point basis point increase in rates is as anticipated. The question, as you say, Jonathan, is the forward guidance. What kind of tone are we going to get from Christine Lagarde in about 30 minutes' time? I'd like to also take your attention to some of the other things that we're also seeing here now, because the other thing that the ECB is putting out right now is also their forecast on inflation for the year going forward. This is absolutely crucial. The prior forecast for inflation in 2026 was for 2.6%. It is now for 3%. So you're getting that inflation readjustment higher and higher and higher. And as we've been talking about, it's not just the headline number. It's not just the sort of energy inflation figure that the ECB is looking at. We've seen core rise substantially. We actually saw it, accelerate at a faster pace, in a faster acceleration in the month of May than the headline number. So these are all the issues that are going to be confronting the ECB. The question is this the beginning beginning of a rate hiking cycle. Depending on who you ask, it's even a mistake that they're raising rates today. We spoke to Jeffrey Yu a little bit earlier in the week. He said that if you raise rates this week, you're going to be cutting by Q4.
They clearly don't want to be articulating the beginning of a rate hiking cycle. Lisa, just looking at the language and going through the statement and the headlines from it and listening to Ollie, it's a central bank that wants to take it meeting by meeting. Based on that, that's what you'd expect to hear from Christine Lagarde in about 20 minutes' time.
Which is why they increased their inflation expectation over the next couple of years, because potentially you could interpret this as them not wanting to curtail growth too quickly and raise hikes too significantly. It's really going to be up to her in terms of how she's messages this, because right now you can read this in different ways. Data dependency, not pre-committing to any kind of path, could be taken as a more dovish take. At the same time, if she comes out and says, we're looking squarely at CPI at X level and we're going to hike again if it stays there, well, that's going to be viewed as hawkish.
Ollie, how haunted is this institution, this committee, by 2008 and 2011 and the hikes they made in those years?
Yeah, what's interesting, John, is they seem currently more haunted by 2022, right, which was acting too slowly on the inflation side of things. And when you think about the stagflationary dynamic, the message that the ECB is sending right now is that they're less worried about stag, they're more worried about inflation. And that is really the message that you're getting from the ECB. And just another line crossing here, looking at the 2026 GDP forecast, the stagflation side of that, the sort of growth side, that they see growth at 0.8%. The prior forecast was 0.9%. So that's just a reduction of growth forecast by about 10 basis points. That is not something terribly dramatic. So I do think that for the ECB, yes, they're haunted by 2011. That is the big question. They hiked too early. They had to cut rates immediately. But the other question is 2022, and I think that's probably more present in their minds right now.
It's good to see you, Ollie. As always, thank you, sir. Ollie Crook there in Frankfurt, Germany on the ECB. These are the kind of headlines that no central bank wants to be reading or writing right now, when you have to cut the outlook for growth and you have to raise the outlook for inflation, not just for this year, but the next year out as well. And that's the position the ECB's in this morning.
Yeah, and if they were a dual mandate central bank, their calculus would be completely different. Right now, in the face of stagflation, do they continue to raise rates? They said that the decision to raise rates was robust across a range of scenarios, that the risk to inflation still remains to the upside. How much of this is dependent on the situation with the Strait of Hormuz? I mean, how much is this completely out of Christine Lagarde's hands altogether? And how much is she watching the headlines and being like, pick one, guys. Right. We need to come up with some sort of formula for what we do.
Close to a deal or not. James Athey of Marlborough writing the following: I suspect that Lagarde will want to keep all options open, and so I don't expect a massively hawkish communication. I expect her to attend balance and neutrality. James joins us now for more. James, welcome to the programme. We've got the hike, 25 basis points. It's not the news. We were looking for that. It's about the guidance for the next move and the one after that. How neutral do you think this central bank president will be in the news conference 15 minutes away?
Hi, John. Good to see you again. I think she'll try. I think we've learned from prior experience that sometimes Madame Lagarde does struggle with the nuance of the communication. Sometimes I think she tries to use too many words when fewer will do. So I think there's definitely a chance that there's a misinterpretation. Generally, what we see in those instances is that somebody else from the executive, probably somebody like Philip Lane, will come out and sort of moderate the message as needed. But certainly, this is a really difficult, fluid situation. Uncertainty around the Middle East today, let alone the forecast horizon, is incredibly high. So clearly, no central bank, including the ECB, wants to box themselves in.
James, if you could channel Christine Lagarde with just a few words, what would you say if she were actually going to be pithy?
I try and say as little as possible. I got to be honest. I'm sort of in Kevin Walsh's camp in the sense that I think central bank communication has just become a cacophony of noise, and it doesn't help anyone. It doesn't help markets, because it's an incredibly difficult macro situation that we're living through, and it's very easy to get forecasts wrong very quickly. And so communication based on, let's be honest, roughly a sort of guess as to what happens 2 years hence is very likely to be very wrong very quickly. So I think she should say very little, explain that options are open and they stand ready to do what's needed. And I think that's broadly what she will do.
Does it make sense to you, James, that you have an ECB that's facing both a growth shock and a price shock more significantly than the United States, that they'd be hiking rates at a time where the U.S., with robust growth and less of a price shock, but still a significant one, wouldn't even consider a rate hike in the near future?
Oh, wow. How long have you got, Lisa? The answer to that question, I could be here for absolutely hours. I'm going to slightly push back on something you said just a few minutes ago when you sort of explained that this might be to do with the ECB's single mandate. I think potentially, if that is the case, that's ECB really misinterpreting their own mandate to a significant degree, because if you believe any of the sort of theories and models that these central banks use, then inflation over the long term, over the forecast horizon, is going to be a function of these sort of growth, potential growth, natural rate, neutral rate, unemployment situation. So all of the broad economic situation, of course, has to feed back into the inflation outlook over a policy relevant horizon. I think the get out for a lot of these central banks in recent years has been inflation expectations. I'm a big seller of that as a significant driver. Really, what matters is the labor market strength, and not just what people think about inflation, but the extent to which they can actually act on that, i.e. can workers demand higher wages? And that's where today could not be really any more different from the situation in 2022, where it wasn't just Russia, Ukraine and the energy shock. That came on top of just a crazy situation of closing and then reopening the global economy and massive cyclical forces.
James, I've got to jump in. Got some headlines coming from the president. Let's get to this post, this social media post from the president. The language is changing quickly in the last 24 hours. The United States will be hitting Iran, whose Navy, Air Force, radar, anti-aircraft and all other forms of defence, together with most of its offensive capability, are gone. Very hard tonight. He goes on to say, at some point in the not too distant future, we will be taking Carg Island and other oil infrastructure points and assume total control of their oil and gas markets, much like we have with Venezuela, which is working out brilliantly for both Venezuela and the United States of America. So they're the words of the president this morning, and this is the move. Brent crude was a little bit lower, now it's a little bit higher. It's not a major move. We're close to 94, WTI's around 91. But they are pretty big headlines from the president this morning about taking Carg Island, talking about that in a way that we haven't heard him talk about in quite a while.
No, these are very bold statements, and it's a U-turn from the president saying we could see a peace agreement in 2 to 3 days, potentially, and off the heels of the United States already having fresh strikes when it comes to going after IRGC targets. The president saying that they are willing to take Carg Island. Obviously, this is something we discussed months ago when the conflict first began, and the president is now saying that not only that is going to happen, they're going to be hitting them very hard. Potentially, oil's not moving that much higher, though, for the fact that, you know what, Jonathan? We have been here a few times with threats from the president, but at some point, you can't be the boy that cry wolf all the time.
James Athey is still with us. James, how much weight do you put on those headlines this morning?
Again, this is like, Lisa Ann's just covered it there. This is really difficult because we hear so much from the president. He confuses and contradicts himself. But what I will say, and I think your own Javier Blas wrote an interesting piece on this, and it's a dynamic which is being increasingly talked about, is that actually it looks like the supply response and the demand response are much closer. So we've had this massive negative supply shock, of course, but it seems that the world economy has been able to dial down that demand picture significantly. Some oil is getting through the straits in a way that we don't yet understand, but particularly China, the extent to which their imports of oil and oil products has plummeted has really helped to balance the market, and I think that's what Trump is responding to.
This adds an extra wrinkle to a news conference with the ECB president in the next 20 minutes or so. James Athey, thank you, sir. James Athey of Marlborough. The ECB hiking interest rates 25 basis points. The president claiming he'll hit Iran hard and very hard, and at some point in the not too distant future, take Carg Island. We'll get into the details in just a moment. From New York City, you're watching Bloomberg TV. April 17th, the president told us the Strait of Hormuz was about to reopen. It didn't. We've been told repeatedly we're getting closer and closer to a deal. We haven't got one. The president moments ago saying the US will hit Iran very hard, and he went one step further. At some point in the not too distant future, we will be taking Carg Island. We'll spend some time on those headlines in just a moment. Moments ago, a 25 basis point hike from the ECB, a news conference 15 minutes away, some data this morning in America, and PPI comes in hotter than expected. Mike McKee has more. Hey, Mike.
Good morning, John. Yes, PPI comes in up 1.1%, the same as last month. It was expected to fall off a little bit to 0.7% gain. So for year over year, we're at 6.5% now for PPI for final demand. The core rate is up 0.4 on the month, and that puts it up 4.9% for the year. And the core ex-trade is up by 5.1%. That's an 0.8 rise during the month. And of course, that's the category that includes margins for wholesalers and retailers. The big issue in April was that we saw a big jump in services prices. And they're saying this month that it's mostly goods. 80% of the May advance attributable to a 2.8% rise in goods prices. Prices for final demand services only up 0.3%. So this is probably, and I can check this very quickly, but I'm sure this is basically energy prices going up. It's well, this is interesting. Final demand goods up 2.8% in May, the largest increase since the data were first calculated in December of 2009. 80% traced to a 10.7% jump in prices for final demand energy. So headline that caught my eye from the ECB was that the war is creating inflation pressures in Europe. Certainly seems to be doing the same here.
Mike McKee, thank you, sir. We'll come back to you in just a moment. Not a great mix. The wrong kind of upside surprise on claims as well. That came in at 229. The estimate was 220. Previous read 225. Historically, still very low in the 220s, but not a great mix when you look at PPI coming in hotter than expected this morning.
To the idea that the U.S. is completely distinct from Europe, this is stagflationary light, on the margins, not stag light, but the idea that you're having slowing growth or potentially a slight increase in jobless claims while also seeing the highest producer prices rising at the fastest pace since 2022 gives you a sense of what we're dealing with here. And do we reach that tipping point where the U.S. consumer can't keep pace?
We're facing an energy shock because of the situation in the Middle East. The extra wrinkle this morning, this statement from the president just moments ago out on social media. I'll share the quote with you. The United States will be hitting Iran very hard tonight. At some point in the not too distant future, we will be taking Carg Island and other oil infrastructure points and assume total control of their oil and gas markets. Tyler Kendall tracking the story. Hey, Tyler.
Hey, John. Well, clearly a significant threat and escalation that's been put on the table from President Trump, but also one that we've heard from the White House before. We have to keep in mind that about 90% of Iranian crude exports flow through Carg Island. And while the country does have other export terminals, none are considered to match the sort of capacity that Carg Island filters through every day. This is raising questions, though, about what this actual operation would involve, including whether that would mean American boots on the ground. We've previously heard the administration float the idea that if they had total control over the air, that may make such an operation safer actually going into Carg Island. But we're going to have to see how this actually plays out, as we know that significant risks still remain when it comes to the Strait of Hormuz, and as Iran threatens that it is only going to tighten its grip over the waterway. A statement from the IRGC overnight saying that they were going to stop all commercial shipping as they ramp up their own threats in response to the U.S.'s airstrikes overnight. John, at this point, we'll have to see where it goes. This has long been in President Trump's sights, of course, and just yesterday, the administration did confirm that it is trying to help more oil get through the waterway. President Trump saying that so far the U.S. has guided nearly 200 vessels since the ceasefire began.
Tyler Kendall with the latest. Tyler, thank you. This was a March-April conversation. It's June and it's back on the table when most people in this market believe, and many still do, that this president is committed to de-escalation and not a resumption of hostilities.
Right, but the president continuously does say this can end the easy way, like a piece of paper at the negotiating table, or a hard way. Has his patience worn too thin right now, and he is willing to begin hostilities once again? You have to look now at the direction of travel of not what he says, but actually what he does. What does happen overnight, and what happens in the next few days and weeks? Does the United States make a move on Carg Island? And then we'll really know the direction of travel for this administration.
All these stories go together. PPI coming in harder than expected off the back of an energy shock. The president talking about going into Iran and taking Carg Island. What that looks like, I've got no idea, but threatening to do just that. That could exacerbate the energy shock that we see in the data already. Where does it leave the central banks? Can they look through all of this. This from Deutsche Bank and Mark Wall just moments ago. This is a significant moment. Not only is this the first ECB hike since 23, it's also the first hike by one of the major global central banks in response to the energy shock that we're discussing. The ECB is saying that a look-through strategy is not a robust response. Nita Richardson of ADP is with us around the table. Nita, good morning.
Good morning.
Can you maintain a look-through strategy as a central banker right now?
Right now, looking through is looking as clear as mud because you're seeing the inflation pick up in the goods sector. That is a sector that had been having some stability in terms of inflation. The inflation was in the service side. And if I could link the PPI with the CPI from yesterday, we also saw a pickup in housing inflation. Remember, housing inflation was dominating that print just a year and a half ago. So if you're seeing a rise in housing and a rise in goods inflation, that is a notable change that I think it's going to be hard to look around.
John was talking about Mark Wall from Deutsche Bank. He went on to say the question is how far can the tightening cycle go? And he's talking about the European Central Bank. He said not far, because while there is upside risk to inflation, there's downside risk to growth. Is it the same here in the United States, or right now, based on what you're seeing in the labor market, is there potentially upside to growth that people are not pricing in?
You know, the starting point here in the United States is exceptional, and it has been for years. There's something about this economy that keeps wanting to grow. Despite uncertainty, despite geopolitical conflict, it keeps growing. And that's certainly true in the labor market. When you look at all phases of the labor market, whether it's, well, let's just focus on pay. The pay rate has been very stable. There's no sense of any kind of inflationary cycle going on in wages. And firms are hiring. We saw 2 months of back-to-back solid prints. So it's hard to say that the labor market is feeling the tension that we're seeing geopolitically, but there is some signs that consumers are withdrawing a bit. They are responding to higher gas prices, and how they look through gas prices is really the question. Not what the Fed can look through, but what can Main Street look through when it comes to summer travel.
Well, to that point, it's connected to the jobs picture. We've been hearing all morning that ultimately we're at a tipping point where either wages go up or spending comes in significantly. Which is it?
Well, if you look at wages, they are going up. They are going up year over year at a really steady clip. And in fact, if you look at base and gross, they continue to grow. But where they're really surging, ironically, or maybe relatedly, is in the goods sector. When I look at wages for job changes in construction, natural resources, and manufacturing, they're all double digits, and they're all higher in terms of their acceleration rate than they were last year. When I look at services, flat to declining. So we are seeing a little bit of an impulse tied to labor shortages in the goods sector, and you match that with wholesale prices today, you're starting to see these things come together in a way that you'd rather they stay apart, which is an acceleration in price points.
Are wages going up or bonuses going up?
Right now, just wages. And, well, sorry, right now, bonuses. Firms are really reluctant to cut wages, and so they'd rather, to keep their talent, especially in labor shortages, they'd rather just give a bonus. But the more sustained that shortage is, they're going to have to respond with a more permanent lure, and that's going to be an increase in the base pay. And that, once that's permanent, and every other bonus is based on base. So that increases labor costs broadly. Firms are reluctant to do that. That's kind of the last resort, but you might start seeing that over the summer if these labor shortages in the goods sector continue.
Nita, always good to see you. Nita Richardson there of ADP off the back of this hotter than expected PPI data. If you looked at the market's not really blinking in the face of some of these risks right now. Still positive on the session, erasing some of the gains, but still up by a third of 1% on the S&P 500. If you check out the bond market, front end of the yield curve, yields are up by a single basis point, Lisa, just 4.15. And as for crude, WTI and Brent up by not even 1%. Off the back of those headlines from the president.
There are so many different things being thrown at this market. It almost feels like, when you have all the pistons firing like this and everything just goes straight. It's sort of like the paddling duck, right? And at what point are people just sort of unable to price in one direction because there's so many narratives that are competing with one another? What Nila was just saying about the inflationary impulse is important, and it suggests that maybe the Fed should be the one not looking through this, not necessarily the ECB, that it's looking at a lot of downside risks to growth.
Mike McKee's still standing by, going through the data. Mike, have you got more? What do you see on a second look?
Well, I think the thing that really stands out to me is not so much the energy price increases, although we saw a lot, including a very big increase in diesel prices. That's to be expected. But it looks like we're starting to see some of these war-related costs spread beyond the energy sector in final demand goods. We're seeing it in plastics. We're seeing it in materials, industrial chemicals, and natural gas. Liquids also rose. So this is the kind of thing that the Fed has been more afraid of, that it's not just a passing energy thing, that it starts to get into other parts of the economy. We also saw a big rise, 4.8% in the portfolio management services area, which does feed into the PCE. So good news for Jamie Dimon and his friends on Wall Street. Bad news, though, for the folks who are tracking inflation from the PCE target side.
Mike McKee, thank you, sir. Jamie Dimon and his friends on Wall Street making lots of money from a certain IPO. I've got some headlines to share with you. The SpaceX IPO is said to draw more than $70 billion in retail orders alone, said to allocate at least 20% of the IPO to retail investors. The orders for institutional investors closed just after the close yesterday. Today is about pricing the IPO. I've already picked the price before the roadshow even started. Quite a bizarre process here with SpaceX. It starts to trade tomorrow.
Yeah, the idea of retail investor participation goes to the cult of Elon Musk and how much it's really cultivated this entire Reddit crowd of people who are enthusiasts in space and robots and artificial intelligence. And ultimately, it highlights the different composition of some of the investor base of this particular issuance, whether it comes to retail investors or whether it comes to just the general float in passive funds. And that is what people are looking at when they say, maybe we should get ahead of that.
What a moment for financial markets worldwide. We're going to see one of the biggest IPOs we've ever seen, if not the biggest IPO we've ever seen in the next 24 hours. We're pushing a lot of equity down the throat of this equity market at a time where prices are starting to rise off the back of an inflation shock that might be exacerbated further by presidential action, and central banks are starting to respond. The first major central bank, the ECB, hiking rates by 25 basis points. Ira Jersey of Bloomberg Intelligence is with us for more. Ira, do we have the space for all of this? Are these central banks just going to sit by and watch, or will they follow what the ECB's just done?
Well, I think the Federal Reserve is going to sort of push and pull here because there's a lot of doves who are looking at some underlying information and data in the labor market, as well as some of this inflation data, and suggesting that, hey, this is the peak, right? So we have to keep in mind that they're going to be thinking about what happens over the next 3-6 months, a year. And when you even look at the inflation markets right now, and you look at what the market's pricing, this is supposed to be the high this month and in May, and then it will moderate over the course of time. So I think that the Federal Reserve in particular will probably sit on its hands for most, if not all, of this year. But I think there is the increasing risk that if the economy does remain good and wages continue to climb at a reasonably decent pace, that the Fed's next move might be a hike. Now, it might not be till 2027, but the market's going to price that well in advance.
Ira, what's your reaction to the ECB this morning? You've been around for a while. We all remember the hikes from 2011, 2008. Do you think they should be conditioned by that, the mistake they made all those years ago, or conditioned by how slow they were coming out of the pandemic?
Well, I think for the ECB, it's a little bit different, right? Because keep in mind, they have a single mandate, right? So their mandate is price stability. So they have to take that into account. I think that they are not going to be overly aggressive, however, because they also realize that if they go too fast, that could actually, harm the economy much more. But this was well telegraphed, right? We all knew that they were going to increase rates this month. Hugh Worthington, my colleague in London, who covers the ECB, one of the things that he's noted is, their inflationary environment is actually much worse than it is here in the U.S. in many respects, because energy is actually a larger part of their basket, and they don't have as much domestic production as we do here in the United States. So there actually are shortages in some places and in some industries. So it is much different, and they need to crimp demand a little bit there in order to make sure that they meet their mandate.
Ira, good to see you, buddy. As always, Ira Jersey of Bloomberg Intelligence. Lisa, you've talked about that repeatedly, endlessly, the difference between the central banks, a very different mandate.
Well, yeah, and I appreciate that James Athey pushed back on that, saying that if you have a single mandate, the idea that slower growth is going to lead to lower inflation could be actually offsetting and creating a dual mandate. OK, but moving forward, there is a real key question here, which is this the appropriate response to curtail demand, especially at a time, remember, a lot of these governments are borrowing more money to finance the gaps in terms of helping people pay for more gasoline. So in other words, it's not going to necessarily create more of a price response or slow demand. It's just going to increase the bill for all of the governments that are going to try to plug this by borrowing money and then giving handouts. I mean, this is a really interesting moment.
What a crazy 30 minutes for financial markets. Right now, just ignoring it all.
Yeah.
Future's still just about positive. Let's get you an update on news worldwide in just the last 30 minutes or so with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, exactly. We'll start with recapping the data we just got. So May producer prices coming in just slightly hotter than expected, 6.5% year over year compared to estimates for 6.4%. Jobless claims came in at 229,000 last week, and that was above the estimate for 220,000. Then President Trump posting that the U.S. will be taking control of Carg Island, quote, at some point in a Truth Social post, adding that he is also planning to assume control of the island's oil and gas markets and vowing to strike Iran, quote, very hard tonight. The European Central Bank also hiking interest rates for the first time since 2023. The central bank raising inflation expectations while lowering growth projections in the years ahead. The ECB President Christine Lagarde is set to speak in just a few minutes. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you for that. In just a moment, we'll take that news conference with the ECB President, Christine Lagarde. We can take pictures of that right now. You can see the photos have just started. You'll get the introductory remarks. When it begins, we'll actually go to it. In the meantime, we've got to track the latest developments coming from the President, threatening to strike Iran once again and going one step further in the last 20 minutes.
One step further, saying potentially very soon we could be taking Carg Island. You know, a viewer messaged me and said, well, which is it, Annmarie? Is it we're very close to a deal, which the president continues to repeat, or are we imminently about to take Carg Island? Thank you for your attention to this matter, according to this viewer. Well, we don't know right now with the president because he is doubling down on wanting to go after Iran today after his messaging yesterday, as well as kinetic activity yesterday. It's a very bold statement. At this point, you have to watch what he does, not what he says.
Brent crude, just bring up the prices right now. For Brent, for WTI in the commodity market, we're up by just 0.5% off the back of a major threat from the president to really escalate things in the Middle East. We have barely blinked in the commodity market. I've talked about this level repeatedly. 98's the high of the week. It was on Monday, and things have got worse, not better, since then, and we're trading at 93 on Brent.
Verbal intervention isn't working anymore. That's the takeaway. In either direction, either up or down, verbal intervention is not being bought by the market because it's been deployed enough times where it hasn't come to fruition that people have learned to ignore it. At a certain point, there is this feeling that it is to escalate to de-escalate, and that it seems to be what people are banking on right now.
How far can these tightening cycles go at central banks? It's quite a moment. It's the first rate hike from a major central bank, 25 basis points. To your point from Deutsche Bank this morning, not far is their answer.
They only think that one more rate hike can get into the pipeline. That is in September. And then after that, not so much, as people look to the deceleration in growth in the region.
How vulnerable are they to events taking place elsewhere right now? These headlines crossing. The president on the phone to Fox News at the moment saying that my preference has always been to take Carg Island.